Asia as well. Continuing that theme, CATL, as Guy mentioned earlier in the show, gives the batteries to about a third of EV makers around the world, including Stellantis and Volkswagen. We'll see if this actually moves the market, Guy, when it comes to the opening trade.
Yeah, we're expecting a bit of softness to come through. I think there's a few idiosyncratic stories that I think are going to be interesting to watch. Next is definitely going to be one of them. Just more good news for the EV sector here in Europe coming out of that CATL story. Right, let's get the trade going. Time for the opening trade here in Europe. Let's take a look at some numbers and figure out what is happening here. As anticipated, the FTSE 100 out of the gate a little bit soft, not by much. We're down by, let's call it 1/10 of 1%. So a fairly well-balanced market, dipping a little bit maybe now. Let's see what we get elsewhere, because it's interesting. There you go, stock 600 actually fairly flat. You've got potentially the same story coming through elsewhere, but the CAC could be a little softer this morning. We'll watch how it opens. As you say, there could be names like Stellantis that could be firmly in focus this morning. IBEX is a little bit soft. I don't think there's much really to get our arms around here. So the FTSE 100 underperforms a little bit again, not by much though. Elsewhere in Europe, a flattish open. What's going on below the surface? Let's find out.
Yeah, Guy, when you look at some of the movement already to the downside, I'm going to start with the negativity here. You are seeing some of the more basic resources taking a little bit of a step down right alongside healthcare. It's a little bit of an interesting move. Novo Nordisk, for example, is going to be your biggest index contributor to the downside, your biggest weight, I should say. But you're also seeing tech on the back foot. ASML, which of course enjoyed that major rally yesterday, pairing some of those gains today. And as I mentioned, some of the basic resources, Rio Tinto as well, taking a bigger hit. But it's not all doom and gloom for the tech space. We are seeing Schneider Electric actually continue its rally from yesterday, which was one of the major movers. SAP higher as well. So I'm curious how much of that may be a little bit of the Jensen Huang read-through.
Yeah, I'm trying to see if my eyes are correct here. Next shares up 2.7%. Sodexo after their earnings down 6.4%. We were mining the chip stocks. ASML down 0.25%. ST Micro flat to the upside. Break it down by sector, about half in positive territory. We've got retail at the top of the basket, higher 0.5%. Healthcare at the bottom, Guy, down 0.7%.
Novo Nordisk is down again. I think it's really, this stock has been under quite a lot of pressure recently. I was just going to try and bring up a share price and see what it's been doing over say the last 30 days. Obviously, we had that big drop at the back end of last year that is worth paying attention to. But Novo Nordisk, you can see, like, so over the last 30 days, I've got the charts up. Over the last 30 days, the stock's down by 16% still. Last few sessions, it's moved lower and lower and lower. It seems to be a stock that is under pressure right now, hasn't really recovered, hasn't bounced back, filled the gap that we saw back on the 20th of December when we saw that huge move lower. Just hasn't been able to fill that story. And once again, it's at the bottom end of the stock 600.
Down 40% from last year's highs, our very own Dan Curtis telling me. So a major move, of course, for one of the core six, the sensational six, not so sensational anymore. We should also mention the tech space is, of course, front and center. We are seeing Schneider Electric as your biggest now index contributor to the upside, and that is continuing the move that we saw yesterday as well. At the same time, perhaps getting a double tailwind from maybe the commitment, what we saw on Friday from Microsoft, $80 billion of investment in the AI space. That boosted the tech space yesterday. Potentially a little bit of the tailwinds today as well, despite Jensen Huang not really making a ton of waves in his keynote speech. We are, of course, also hearing from the Microsoft CEO, Satya Nadella. He's speaking right now on the AI theme in Bangalore, India, at a venue, by the way, that is kind of hosted and moderated by the industrial space of Industrial Union, I should say, Industrial Association in that space in the major tech hub of India. You can see those live shots on your screen right now. But this really brings up this question of just how much of these kind of oversized valuations that we tend to associate with the tech story may actually be justified.
It's going to be interesting to watch which ones of these companies can actually make it work. It was interesting. I wrote a note overnight. The NVIDIA event was at the Mandalay Bay Ultra Arena in Vegas. People were queuing for hours to get in.
Yeah.
This is kind of, it speaks to the idea that we've reached like rockstar status for Jensen Huang. Obviously, Microsoft is in that camp as well. But it's fascinating to see just the buzz around what is happening here and the AI story and how dominant it is. Trying to find out what the signal and the noise is here is really difficult. And I think that's going to be the narrative that needs to develop throughout 2025. I still come back to the idea that Jensen Huang was talking about the broadening out. He's talking about how you use AI now, how companies factor it into their thinking. He's talking about bringing computers from NVIDIA to market. He's talking about how you incorporate it into vehicles. This is the story of 2025. Does that hold up to scrutiny, I think, is going to be the key question, because the use case has to be there for Microsoft, for NVIDIA, and I think that's going to be a fascinating story for this year. It's going to have a massive impact on valuations.
It absolutely will be. Well, let's bring someone who maybe deals with those valuations on a daily basis. Obi Ejikeme joins us around the program, Global Equities Fund Manager over at Carmignac. You have the fun job of figuring out whether the valuations are too high or too low. Juicy enough to get your interest. What do you think?
Yeah, I think, and good morning. I think the challenge is the valuations seem to be excessive. I mean, relative to history, you're paying a significant premium for these stocks. But I think with all investors, we all look at different stocks in the market and different opportunities, and the problem that we really face today is where else do you go?
Yeah.
You know, the growth rates of these stocks are almost 4 or 5 times the average stock in the market, and so realistically, to get that growth, you're going to have to pay a premium. And I think when you look at different markets around the world and different growth rates of different economies, whether it's Europe, whether it's the US, that seems to be the trend that's been in place, at least not just for the last 12 months, but the last 24 months, which is to pay or to get growth, you've got to pay some sort of a premium.
You know, one of my favorite quotes is from Dan Ives, a major tech bull over at Wedbush, who loves to say that if people looked at valuations at the Facebook IPO, they would have completely missed the Facebook rally. So valuations may not actually hold as much weight. But when we talk about that, you're saying missing out on this massive growth. That growth requires execution. That growth requires this massive scale up, which you're seeing in infrastructure, in AI, et cetera. But there's still a lot to be left to desire in terms of actually seeing those expectations. It is still all growth over the next 10 years. What do you need to be more confident that that growth is actually going to show up, as opposed to just the idea of it in some sort of 1999-esque party?
Yeah, I mean, first of all, this isn't like 1999, and we're seeing the growth already. So, you know, some of these stocks are growing their earnings 30 to 50%.
The growth, but the capabilities are growing as well?
I mean, this is to Guy's point about the broadening out. I think that's what we're going to see. So we're at the early innings of this new technological revolution. This is innings 1. Innings 2 will be the part of that, and that's where I think we'll see the growth story go beyond just the manufacturers, just the software companies to other parts of the economy. That's the hope story.
So what does that look like then? We hear all this about agents. You know, is that really going to take the game on that much? Is it going to be a game changer, or is it just a kind of tweak until we wait for a killer app to make them a game changer?
Yeah, I mean, who knows? I think at the moment what's happening is, and you have to bear in mind, there's a lot of volatility around this. When we started on this sort of trend in 2023, where there was a big explosion of the performance of these stocks, it was very, very broad-based. It was almost every stock you could find, and it was a case of, can we just get on the AI on the train?
Exactly.
And then last year was a bit of a reality check, where actually quite a few of the names had very, very poor performances, and so all of us are sitting here going, actually, we need to be a little bit more careful about how this is going to end. We've got to focus on the winning stocks and the ones that have got the best opportunities, and as you rightly say, look for those opportunities in actually sectors outside of technology, industrials, consumer, all the different sectors which will take advantage of it, but at the moment it's limited to see.
So perhaps a little harshly, I described Jensen Huang's speech earlier as meh. Is that how you see it? Because I know that you don't hold much NVIDIA. It's
been consistently one of our biggest holdings. I mean, actually, we've traded around it because it's quite a volatile stock, and as anyone who's held that stock knows, back in 2020, you lost 50% of your value. So I think we have to be relatively careful about how we own it. It's now one of our biggest holdings, and it probably will be. But I think
don't love it like Microsoft, though.
Yeah, we don't. I mean, we love the story in terms of the type of stocks that we like, which is these high growth, sustainable growth stories. But I think what you have to be careful about with all of these stocks is to make sure you trade around them. And that means that sometimes it will be one of our top 2 or 3 holdings, but at others it may be down at number 10. And so that's how we've looked at those type of holdings over the last couple of years.
You sat down and you said you're cautiously optimistic. I'm trying to work out from this conversation whether it's more cautious or optimistic. Which one do you think it is right now?
I'm a natural optimist.
Fund manager, of course.
And of course, as a fund manager, but actually, general, I think you have to be optimistic about equities, and it's been a mistake not to be.
Yep.
But I think if you look at where we're starting this year, the reason I'm somewhat cautious is because we are starting on elevated valuations, and we are starting on interest rates which are at high levels. And we're going to be dealing with all the problems that were well known, which is government policies, fiscal policies starting to impact on growth for this year. And so my caution is, I think some of the best stocks will do well, but I think some of the stocks which are challenged will
and you know what the best stocks are now, right? Of course, that goes without saying. Yeah. Novo Nordisk. Can I just? You talk about Nvidia, you talk about trading around these kind of stocks, and you talk about Microsoft. Novo Nordisk back end of last year, 20th of December, drops massively. Hasn't filled the gap since. Stock still down by 16%. That was a stock that had really high expectations built into it, and we saw that kind of a drop that the market hasn't come back from yet. Is that something you could see being replicated with some of these other, let's call them high expectation stocks around the world?
Yeah, and look, I think there's a broader reason for why this is happening. The broader theme of there being a lack of growth opportunities. Everyone knows about the sort of the Magnificent Seven and these great companies in the US that have managed to perform really well in the last few years. What they're not talking about is the fact that most other stocks are not. So if you look at the growth rate of the S&P 500, for example, and you strip out the Magnificent Seven, we had 3% profits growth last year. That's almost zero.
Yeah, the S&P is outperforming the equal weight consistently.
Yes.
At the moment.
So what this is doing is it's raising the bar and the profile for some of the names that are growing a bit faster. Now that creates a risk, and I think that's what we've seen with names like Novo Nordisk, and even Nvidia at one point last year had a big pullback over the summer. When you've got everybody crowding into a very narrow pool of stocks, then that creates a risk to the valuation of the company. The growth story is probably intact, and if you're a long-term investor, as we are,
But you've got to pick your entry points.
You've got to pick your entry points. And then if you're longer term and you're thinking 3 to 5 years out, some of these pullbacks are actually wonderful opportunities to get back into the stocks over the longer term.
You said you're trading around it. If you look at the hedging costs around some of these major companies, they're not exactly easy to kind of bid on the upside, for example. The cheaper hedging costs are from the downside because nobody wants them. So how do you trade around it?
Trading is just sizing for us. So, we can get anywhere between 4 and up to 10% in a particular stock. Now, I think that most of these names are super large cap and liquid, so it's actually quite easy for us to get in and out of them in size. The problem you have when you're in the small cap space or the mid cap space is you simply can't do that. You have too much market effect.
So is your challenge sizing or entry points?
Yeah.
So is picking the entry point easy, but sizing's the difficult bit?
Any fund manager that says they can always pick the entry points is often not telling the truth. But I think what we try and do is we look at the long-term profile of a stock. If a stock becomes cheaper than we believe it's worth, then that's a great entry point for us. And so we're looking at a lot of stocks today, and I'll give you examples. In Europe, there's a lot of companies in today that meet our criteria of being long-term winners that are trading on much, much lower valuations than they have done previously. That's an exciting opportunity for us.
But are you sizing into those positions?
That's a strategy for the year. So I think that's where we're seeing the biggest delta of opportunity. It's not really in the US because all their stocks are trading at the high end of their valuations, but in Europe, a lot of these stocks, because everyone shifted towards domestic Europe, it shifted towards the banks, it shifted towards the domestic European stories, all of a sudden, like Novo Nordisk and like some of the luxury goods stocks, they're trading on relatively low valuations compared to history.
Well, exactly.
That for us is interesting.
If I could squeeze in a little luxury here, Hermes, one of the big names that you hold, do you not worry that luxury is going to get tied into Donald Trump's tariff war on Europe?
I think this is where Europe is, and I'm not the biggest European bull. I think the greatest stocks actually today still exist in the US, but it's the pricing disconnect that we saw last year in Europe and Europe underperforming that's created this opportunity for Europe. The risks that you highlighted, the tariffs, geopolitics, even the currency weakness. There are so many things that Europe has had against it. Even government policy and taxation in Europe. Of corporates. I mean, these are all things that were a massive negative headwind for European stocks last year, and that's last year. So the question is as the market discounted that, as the opportunity now this year. And I think that's what looks quite interesting.
I think Kobe just told me that was so 2024.
So last year.
Obi, you mentioned a couple of names that you may be kind of positive on going into the year. Can you give us a taste of that?
Look, I think there's a broad reminder of the strategy that we hold is we look at high-quality companies that are compounding and reinvesting for the future. So generally our view is that we're investing in stocks for 3 to 5 years. I think in terms of the opportunity set, we're looking for stocks where there's been a disconnect of some sort. So that's either the market is focusing on something which is very short term, and we just discussed a few of those ideas, whether it's geopolitics.
So for example, SAP, others? SAP,
long-term holding, Hermes, Ferrari, these are some of the names that I would say in Europe look interesting, but actually our core portfolio is still 60+% US. So I think it's the European stocks today that have been dislocated last year that I think look a little bit more interesting on a relative basis.
Thanks for stopping by. Thanks for coming to see us. Obi Ejikeme, Global Equities Fund Manager, joining us from Carmagnac. Thank you very much indeed. Mentioning some of the names that are on the Core 6, let's take a look at how they're performing this morning. We've already mentioned Novo is and remains under pressure, yet to fill the gap that it generated back on December the 20th. Ferrari's a little soft as well. We'll keep an eye on what's happening in the broader also space. But technology catching a bid this morning. ASML's up, Schneider's tracking a little bit higher. Even Nestle's having a slightly better day. But LVMH is the outperformer, up by 0.4%. Let's see what else is happening. Over to you, Joe Easton.
So we are seeing a gain in Next shares this morning in London. Guy, remember the company reporting sales up around 6% in the key Christmas weeks, the 9-week period. They do warn of some timing effects and also the impact of the rise in national insurance. That was announced by Rachel Reeves a few months ago, taking the shine off that. But a decent gain nonetheless, up 2% for Next this morning. Then in terms of Sodexo, that one getting hit hard over in Paris today, a really big decliner. We're down almost 7% for Sodexo. This is around a €10 billion catering and facilities management company. It's the facilities part of the business that does seem to be weak, according to analysts following their trading report today. So that one, a really underperforming stock this morning on the French market. Then we got Prosus. Remember the big move in that one was yesterday, of course, falling around 2%. On those headlines around Tencent and potential links to China, the Chinese military flagged by the Pentagon, so down around 10% on a 2-day basis for Prosus now, one of the most favoured tech stocks on the street. But one tech stock going up this morning is Kion. Now, this is a semiconductor-based company. They do work with some of the big firms and robotics as well, and they've got a pact with Accenture and also NVIDIA, according to a recent statement. That was announced over at a big conference in Las Vegas, a robotics deal with NVIDIA and Accenture, boosting that one up 8%. That was the best performer that I saw at my screen earlier today. Then lots of ratings once again today. Analysts getting them all out as they come back from Christmas. BE Semi, a big outperformer today. UBS reckons they're about to see a big rebound in demand for some of their chip supplying products. But meanwhile, Alstom, that one really caught my eye this morning. Goldman Sachs cutting this one to sell this morning. Not many sales on that stock. It's down 4% today. Goldman reckons spending in the rail sector is going to decline this year, and therefore they recommend you sell shares of Alstom in that one. A big underperformer today, down 4% for Alstom in France this morning.
All right, Joe Easton from our equities team, we thank you. With some of the big movers at the open, as we're looking at the stock 600 lower 0.4%, the FTSE 100 even more low, 0.7% down this morning. The CAC Cajon 0.3%, and the DAX down 0.2%. Told you it might be a bit of a tepid Tuesday. We'll dig into perhaps why next. NVIDIA unveiling new chips and software as it looks to stay ahead in the race for AI supremacy. But has Jensen Huang done enough to impress the markets? We'll bring you more on that next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the opening trade. We're 20 minutes into the cash session here in Europe. The Stock 600 down 0.4%. Perhaps a bit of caution ahead of the Eurozone inflation numbers later in the day.
We'll look forward to that data, figure out exactly what all those numbers are going to mean. The market, though, feels like it's very much on an AI story this morning. You've got what is happening, obviously, out in CES, but you've also got Satya Nadella, Microsoft Satya Nadella, speaking in Bangalore. I've just been listening to what he's been saying in the break, talking very much about the use case that AI is going to provide and how Microsoft is going to try and disseminate the AI story into a broader and broader range of topics. Let's take a quick listen to what he is saying in Bangalore.
These data centers are just, everything from how we think about even the construction of a data center that is optimized for liquid cool AI accelerators is a new engineering feat. And so that's what we're doing. Everything from how do we then work with upstream from us with renewable energy folks to get onto the grid base load that comes to our data centers that then has the right cooling infrastructure with zero waste and zero water usage. How do we really make sure all of that gets built into at a system level? And then, of course, silicon innovation. We're innovating with NVIDIA. In fact, today, I think we have our first GB200 clusters up live in one of our data centers. Very excited about what that would mean. We're then also working with AMD. We are building out our infrastructure we're building our own silicon with Maya. All of these, in fact, Maya today is taking a lot of the customer service traffic in Microsoft.com. So we're building, I would say, world-class AI accelerator infrastructure, but the entire system stack above it, optimized for training, optimizing the kernels for inferencing. So there's significant investment and innovation that's happening through us, our partners, and so we're very excited. In fact, I think of this as the golden age for systems when it comes to innovation. Now, if you have the infrastructure, the next big consideration, in fact, today I met many partners, many customers. The first thing everybody wants to talk about is it's fantastic, we're talking about AI, but how do I get my data in shape, right? I mean,
he's on a roll, isn't he? He's talking about a lot of investment. He's talking about a lot of big things coming down the pike towards Microsoft, towards its customers. The use case for AI, a big feature of what he's been mentioning in Bangalore, but the investment that backs it up, a golden age for systems, that's going to require an awful lot of money. He's talking as well about the energy story. It was interesting, a few days ago, he was talking about the idea that he's not chip constrained, he's energy constrained right now, and that is one of the big challenges that the AI story is generating right now. How do you broaden this out is something that we're hearing as a clear theme. You heard it last night from NVIDIA, you're hearing it from Microsoft now. Let's get more on this. Tom stepped out of radio, he's here with us now. Tom McKenzie, nice to see you. Well, I want to join the dots for us between what Satya Nadella's been talking about, what Jensen Huang's been talking about. What are we guessing at the beginning of 2025 that is in some ways different to what we got in 2024?
Well, top line, what we're getting that's the same as 2024 is you're not getting any walk back in terms of the enthusiasm when it comes to the spend.
He's definitely on a roll,
you can sense there's no way they're walking back from this in any way. They're doubling down. And that commitment around the 80 billion capex spend this year, which led to some of the upside that we've seen in tech so far this year, earlier this week, that is a tell, isn't it, in terms of Microsoft's commitment to this space. Look, he talked, in terms of joining the dots, he talked about partnering with NVIDIA, but also AMD as well. And that gets us to the question as to how Jensen Huang is positioning. And you touch on this, that he wants to broaden it out into other segments. Jensen Huang, the CEO of NVIDIA, is clearly conscious of the fact that their competitors are coming up. They're a long way from catching up, but clearly he needs to diverse the product mix. And that's what we heard in terms of this speech, keynote speech at CES, where he talked about not just the hardware, but the software component. And it's a reminder that NVIDIA isn't just a hardware play, it's a software play as well. It's got the Coda software that goes with its AI accelerators, but also they released, for example, a foundational model that developers can tweak and use. It's going to produce new synthetic data. Data is a choke point as well. Interestingly, on the energy front, Satya Nadella talking about the energy constraints there. Sam Altman of OpenAI, clearly a partner with Microsoft, said that nuclear fusion is going to solve that question when he spoke to Bloomberg yesterday. So some of the key lines coming through from Jensen Huang, look, the commitment around pushing out to robotics, agentic AI, embedded AI into hardware, into autos, and we had some examples of that, into robotics, talking of a vision and a future where you have 1.5 billion humanoid robots and autonomous vehicles. The question for some analysts is how you make it cheap enough in terms of the hardware getting into those systems to make it compelling.
Well, that was literally going to be my question, because in this conversation that we just kind of dipped into for a moment, he's talking about $3 billion of investment in India. He's already partnering with the local kind of Ambani family created communication system, Jio, and he's talking about partnering with the government as well. Is this the way to diversify regionally when it comes to making this cheaper for everyday use and expanding that use case?
Well, so there's a parallel, isn't there, between what Satya Nadella is doing in India and those partnerships at government level with what we've been hearing from Jensen Huang, who's talked, and he talked about this last year as well, sovereign AI, so really trying to lobby governments around the world to build out their own, if they have the capacity and the financial means, to build out their own AI clusters. That has been a key driver for Jensen Huang. You expect that to continue as well. But also just at the kind of the more consumer level, whether it's in terms of how we interface with cars going forward, the partnership that Jensen Huang and NVIDIA have tied with Toyota, the fact that you're going to have screens and interfaces in cars now, they're going to read your facial recognition to make sure you're not falling asleep at the wheel and giving you more insights and more data in terms of the road conditions coming up. All of that is the future that NVIDIA's looking at if they can meet the price point and if they can get the efficiencies.
Basically, if you can explain it and if you can afford it, therefore, that's the way you get into the hearts and minds of everyone using it. Bloomberg's Tom McKenzie breaking us down the AI story. Bloomberg's Ed Ludlow. We'll be speaking to Jensen Huang at CES in Las Vegas at 4:30 p.m. UK today. Stick with us. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trader at 30 minutes into today's session. Red on the screen across the board when you're looking at the continent. The sole outperformer is actually the Swedish stock index. There's some interesting plays there, but broadly you are seeing red on the screen across the board, and perhaps a little bit of paring back some of the moves that we saw yesterday. The outperformance in tech, certainly the hindrance for today. And we're also on top of that getting a host of inflation data from Europe out today. CPI ticking higher across the region. Bloomberg's Zoe Schneeweiss in Frankfurt joins us this morning. She's all over this story. Zoe, we got Swiss CPI, we got French CPI, we're going to get the Euro area CPI and Italian CPI in a little bit as well. What is the common theme here in a backdrop where so many people are talking about preparing for some sort of cost push inflation?
Yes, so the overall trend we're seeing here is an uptick in inflation for the December read. We've already had that last week when we got the Spanish number, and now because of the holidays they were delayed a little bit. We got German data yesterday and French data this morning, and all of them see that uptick. The German uptick was a bit stronger than anticipated, the French not quite as strong as anticipated. Overall, though, all that will filter through to the euro area number, which we get in about an hour and a half, and that number is likely to see an uptick. In November, it was at 2. Inflation in the euro area stood at 2.2%. Now we get the December reading. The economist estimate here is that it will be at 2.4%. Given the very strong German print, it could have been a tad stronger, but still overall there'll be an uptick here.
Am I going to hear the word gradual a lot more, therefore, as a result of this? The ECB increasingly gradual. I'm not sure how many variations there are on gradual, but does this impact the rate path, this data?
So it does give those members of the Governing Council some support who says we should stick to 25 basis points. Gradual is the overall theme, though. So the overall expectation here is that at the first 4 rate decisions of the year, and because of the timing of ECB rate decisions, that would be the decisions through June, there will be 25 basis point cuts at each one of these meetings, which would take the deposit rate from currently 3% to then it would be 2%. There are some policymakers, especially the Austrian, who say, hey, we maybe should wait a little bit. And others have said we can stop one meeting, and others have said that if needed, 50 basis points, which is something the ECB hasn't deployed in this rate cutting cycle, could be on the table as well. Overall, though, the general consensus does seem to be 25 basis points. Given all the uncertainties that are out there, the German elections, the situation in France, and then, of course, Trump tariffs, that isn't completely surprising that they'd want to be cautious here.
Well, yeah, just talk us through what other risks are out there, Zoe, as we head towards this next ECB meeting at the end of the month. It sounds like I shouldn't be cancelling my next flight to Frankfurt.
Yeah, so the rate decision is on January 30th. That, in a way, is a inconvenient day for the ECB, because that day also is the day that the big euro area economies all say how they performed in the fourth quarter of last year. Overall economic weakness is something the ECB is quite worried about, because if the economy is weak, that feeds through to inflation and stops prices increasing. And as we know, the ECB does want price increases of about 2%. So that's the one issue. Then we've got the German elections, which are just a month and a half away, where we are very likely to see a regime change in Germany. We've got all the uncertainty over France, where it's really unclear how this new government is going to get through a budget. And then, of course, the Trump tariffs is one of the things. We saw how markets reacted yesterday with all just the reports and then rejections of reports regarding Trump tariffs. So anything that happens there does create a lot of uncertainty, and also tariffs, if they are implemented themselves, and then if there might be retaliation, that just has a huge impact on the euro area economy and therefore on the ECB.
All right, Bloomberg's Zoe Schnee-Weiss in Frankfurt, we thank you as we walk towards that euro area inflation print at 10 a.m. London time. But staying with the economics and how it feeds into the politics, let's go to Canada next. Justin Trudeau becoming the latest world leader to be toppled by a struggling economy, and following very much in the wake of US President Joe Biden, Rishi Sunak as well in the UK, and Olaf Scholz appearing set to lose next month's election in Germany as well. Let's tie this all together and bring in Bloomberg's Oliver Crook for the European implications. Ollie, just talk us through this instability that we're seeing across developed economies.
Yeah, so listen, Lizzie, I mean, I think it's fundamentally connected to exactly what Zoe was talking about, this issue of inflation, where basically you've had this phenomenon, obviously, since COVID, and we're still sort of grappling with the political consequences of it, the sort of extreme inflation across the Western world, where effectively, you know, people who are earning money, who do not own assets, the value of the money goes down, and meanwhile, the value of assets is going up. It's effectively a sort of wealth transfer from people that don't have as much to those who have a great deal. That is being felt politically, right? This is the sort of theme that we've seen across the world, the inflation, the cost of living. This is what has led to a lot of the oustings of many of these governments. But it's not just that, right? There's also this question of climate backlash, this idea that basically that we're putting these sort of principles and these ideas above basically the day-to-day practicalities of having cheap sort of energy costs, and of course also seeing it sort of materialize in immigration. I mean, I was just looking at the G7 leaders. I mean, if it's really remarkable, you pull up the screen of all of the sort of G7 leaders. In the last year, they have either almost all been replaced, are incredibly weakened, or about to be sort of pushed out, whether it's Joe Biden, Olaf Scholz, and now Justin Trudeau. I mean, there was an election also in Japan, and Keir Starmer, Macron. The only person on that board that is coming from any sort of position of power is Giorgia Meloni, who's been holding on for a while now. And, you know, that was after a sort of a long period of instability over in Italy. And when you think about the sort of global ramifications of this, I mean, the G7 is supposed to be the stable core of the multilateral order. That is not at all what we have going into this year, where Canada actually is supposed to take over the presidency of the G7.
Quite the timing, of course, but a lot of those issues that you just outlined, inflation, immigration, among others, they're actually driving the story in Austria as well. Give us the state of play there.
Yeah, so listen, Kriti, I mean, it's so interesting because it's like there's so many echoes in this Austrian story that we're seeing across European politics. You know, now you have basically the sort of far-right leader, the leader of the Freedom Party over in Austria, Herbert Kickl, who won the election over in September but was not given a mandate to sort of form a government because nobody would work with him. He was basically boycotted. Now the chancellor has resigned after they could not bring together a centrist coalition. And what you have now is likely Kickl, who will work now with the new head of the Conservative Party in order to form a government. Now, his platform, he's running on sort of anti-immigration, so-called Fortress Austria. This was sort of to suspend asylum seekers and to deport people. There's, of course, the pro-Russian bent. He sort of doesn't want to support Ukraine, wants to see sanctions go off of Russia. And, of course, not only climate skepticism, but also sort of EU skepticism. Now, he doesn't go as far as the AfD does, for example, in Germany. He's not calling for an exit of the euro, but he is very, very skeptical of the European project. He is also going to be leading Austria. This means that there is another party as a head of a member state at the European level that joins Orban's group, the Patriots for Europe, within the European Parliament. That makes things a little more complicated.
Are alarm bells finally ringing in Brussels?
I think they're ringing very, very loudly. I don't know that they're actually, frankly, ringing sort of loud enough. You try to tie all of this stuff together, because what this commission is trying to bring together, Guy, is not just a sort of little bit incremental move in the EU. What they are actually advocating is a giant leap forward of European integration. They want to see it on capital markets and banking. Every single one of these ideas comes with a cost. On capital markets and banking, for example, you need supervision. You need to surrender some sovereignty. If you want to see European champions, the cost of that will be some national champions. If you want to see collective defense, you want to do more spending, you're going to have joint debt. If you want to focus on climate, these are all things that there is a huge amount of resistance to at the sort of a national level. These are not the ingredients that you have in place in order to bring a sort of Europe to a giant leap forward. That is going to be a focus for the European policymakers here. And we're going to be speaking to the competition commissioner. This is the new position that has been made, an executive vice president by Stéphane Séjourné. This is out of Macron's party. This is the person charged with European competitiveness. We'll talk to him a little bit later. Are the ingredients here to make Europe, great again, or is it going to be basically paralysis into sort of economic demise, as Mario Draghi and Macron are warning about?
Make Europe great again. We'll see what happens on that front. Ollie, thanks very much indeed. Tying all the threads together in terms of the politics and the impact that we're seeing around the world. As he says, we have a fantastic conversation coming up for you right here on Bloomberg, an exclusive one with the EU Commission Executive Vice President, Stéphane Séjourné. You'll be able to catch that interview Wednesday, right here on Bloomberg Television. Looking forward to that. Let's talk about the market implications of all of this. Monday starting a little quietly when it comes to the currency options market. It changed as we saw the WAPO story coming through, the Washington Post story. Then we saw the rebuttal from Trump. The euro's been all over the place, but we've got a 104 handle right now. What are we going to see in 2025 when it comes to the currency markets for the single currency? What are we going to see? Valerie Teitel has joined us around the table to make some predictions, which seems like something that's only the brave are doing at the moment.
Yeah, well, I think the one thing we know for certain is volatility in FX is here to stay. I mean, what a session yesterday. You had the first day coming back from the holiday all ready and prepared with your euro shorts, and that WAPO article, you get massively stopped out, and then you miss the snapback on the Trump denial. I mean, we saw that in the FX currency markets yesterday, some reports out there from Bloomberg reporting saying that we had such a very large volume surge in FX options. A lot of those bets and options market on euro parity seem to have been stopped out on day one of liquid trading for the year. And going ahead, it's going to be a volatile one. I think markets hope that we get a clear message from Trump on what he intends to do with tariffs. But we're hearing from the street that we're really unlikely to get that. George Saravelos at Deutsche Bank saying we should not expect one specific implementation timeline. We should be getting ready for overlapping legislative and executive initiatives, rolling deadlines, and various announcements, not just throughout January, but throughout the entire year when it comes to this tariff situation. So we're buckled in for some volatility on the FX market. Some they're out there licking their wounds already on their euro shorts.
In the meantime, taking off some of that duration risk as well.
Yeah, that's right. I mean, another theme, if you can call it a theme, we've only had 3 days or so of trading of the new year, has been weakness in the Treasury market, prevailing weakness in the long end. It has gone global. We saw Japan JGBs in the long end reaching levels not seen in 15 years. And then here in the UK, the long end of the UK gilt curve seems vulnerable as well. You saw 30-year yields yesterday nearly touching 520 on the 30-year gilt yield. And again, you think about the vulnerabilities out there. One mind goes right to the UK, where you have fiscal headroom being eroded, not because of anything happening in the UK, but because of what's happening with the U.S. Treasury market, where it's pushing global yields higher. You have to also think that in the UK, they have a very long duration in terms of their average debt maturity. It's around 15 years. So they're more exposed to this winging around of long-term yields than, say, any other European economy. It's going to be an interesting one, especially when it comes to the UK, because of one reason is that their FX did outperform last year. If you look at the currency pair of sterling specifically, it was the best performing currency pair last year. And normally you get a bout of currency weakness that almost helps you stabilize some sort of economic weakness. And we didn't really get that in the UK. So I think there is starting to be some coalition of mind that the UK is going to be a weak spot when it it comes to this rise in global yields.
I mean, how worried should Rachel Reeves be? Because we were talking about these yield moves anyway, because she'd left herself so little room after the budget. It seemed like maybe she'd have to come back again. Does that now seem inevitable that in the spring she's going to have to come back for more?
Look, we saw the FT reporting on this last week that they could, in fact, have to maybe change tack with what they've done. We've had 2 back-to-back months of zero growth, and alongside of this, we have yields marching higher and the currency not weakening to give us some sort of stabilization. So it's going to be an interesting one to watch, Lizzie. I know you'll be on top of it as well. But yeah, the UK does seem to be the one that could be vulnerable to any further sustained steepening of the Treasury curve.
All right, Bloomberg's Valerie Teitel, we thank you. Unless you want to ask about the yen, critic.
No, while we're at it, we're talking about stability and all. Talk to us about the yen story. I mean, you mentioned the verbal intervention, the jawboning earlier in the show. How digestible is that? We're looking at a 157 handle.
Well, look, if you're one who is piling into this U.S. exceptional slim trade, you want to be long dollars. The big risk to that is a hike sooner than expected from the Bank of Japan that would weaken the dollar. We saw the hints of that overnight. There was some verbal intervention when the yen hit a 6-month low at 158.50. It nearly hit. The last time we saw sizable FX intervention was around the 160 handle. So maybe we're still a bit farther away from that, but it's still something on the top of investors' minds when you think about if you want to be positioned long dollars into this year, one of the biggest risks to that position.
All right, Val, thank you. Good to have you with us this morning. And coming up, we're going to touch on Guy's favourite subject, one of them, used Rolex prices. I know he loves a bargain. Falling to 3-year lows. We'll bring you the latest from Bloomberg's Subdial Index next. Do stay with us. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to the opening trade. We're at 48 minutes and change in today's session. Seeing one of the losses that we opened the day with kind of getting pared back a little. Not so much excitement in the fact that we are still flat on most of the major indexes. Barely marginal outperformance in France there, and underperformance, I should say, right here in the UK. The FTSE 100 down at 0.3%, but still a positive move from where we started in just 48 minutes time. Now, a lot of this may have to do with some of the moves that you're seeing around a lot of the political news. And that certainly is a major theme this morning, specifically when it comes to the relationship between the U.S. and China. Shares in China's gaming giant Tencent and global battery manufacturer CATL dived in Asia trading after the U.S. blacklisted the firms for alleged links to the Chinese military. Joining us now for more is Bloomberg senior reporter for the Chinese economy and government, James Mager, joining us this morning. James, bring us up to speed on this blacklisting. What does it actually mean to be on this list?
There isn't any actual immediate effects that being listed on this list from the Department of Defense will have. People can still do business with them. You can still contract with them. GM or other American car companies can still buy batteries from CATL. There is a provision in the future that the Department of Defense may not be able to contract or to sign contracts with these companies or to buy goods which contain goods from them. So maybe in the future, this would affect their sales in the U.S. But the biggest sign, I think, is that fact that these companies have now been targeted by the U.S. government, and this could lead to to more strict sanctions, like from the Department of Commerce or the State Department in the future. And even if that doesn't happen, there's still, the U.S. government is signaling very strongly that they don't want U.S. nationals dealing with these companies. And you already saw last year, you saw CATL batteries being pulled out of a U.S. military base after Marco Rubio and other lawmakers complained that Chinese batteries were being used to power in an energy storage solution in a U.S. military base. So even before they were listed on this, even before CATL was listed on this list, you did already see them losing some business opportunities in America, and that may well continue. Once we get into the Trump administration, especially if Marco Rubio and other China hawks are populating senior positions in the administration.
So you've got Tencent saying they're not a military company, but how much scope is there for the companies on this list to challenge being on it?
Some companies have successfully challenged being listed on this specific list, the Department of Defense one. Hersey, for example, which makes LiDAR, which are used, basically it's kind of a laser that cars, EVs use to sort of, make a map of the world in front of them. They were listed and they were removed, and then they were listed again and then they've been removed. So there is some possibility that Tencent can basically sue to get off this list. But they could also be added back on if the Department of Defense then doesn't accept their explanations on why they shouldn't be on the list in the first place. But it also does set them up for future possible listings by the Department of Commerce, as I said, and it just makes them more of a target, and it makes them a little bit less attractive. If you want to make an investment which isn't going to attract any geopolitical risk, are you going to invest in a company or invest in a fund which is invested in this company, which may well have this risk attached to it now or in the future? It just makes them a little bit more unattractive, and I think you saw that price reaction today in the market, with those big stock price falls for Tencent, CATL, and other Chinese companies, because it's not just those two firms. It's companies like SenseTime, it's Changxin, which is a huge Chinese semiconductor, shipbuilders, shipping companies. They're all on the list today, and they all saw these kind of price reactions.
We're starting to see some reaction, though, from the companies. Tencent intending to initiate a reconsideration process. How long does that take? What is the process? How quickly can it have an effect? Other companies have been successful in these efforts. What are the chances here?
I mean, the chances are up to the Department of Defense. They get to decide who is on the list and who is not. There's no legal process for which this can be challenged, as far as I understand. Basically, the companies now have on the notice it says, please send your objections here, and please give us reasons why you shouldn't be on this list. So, Tencent or the other companies can now have their lawyers write up a document saying why they're not connected to the military and why these accusations are wrong or misleading or false. And they can send that to the Department of Defense and ask for a reconsideration. I'm not sure how long that will take. For Hersey, the process of being added and then subtracted has been quite lengthy over the last couple of years. But we'll probably see this playing out in the future. But this is part of the U.S. sanctions toolkit on Chinese companies. There's many other kinds of tools that the government can use if they want. In the first Trump administration, the Trump administration banned U.S. nationals from investing in companies that were connected to the Chinese military. Yep. So that, again, even if you're not on this list, that could be damaging for other Chinese firms as well.
Thanks for the update, James. Really appreciate it. James Mager joining us out of Beijing on the latest out of the United States in terms of the restrictions that are being applied to Chinese companies. Let's turn our attention to another subject. The prices of the most sought-after used Swiss watches have fallen again, hitting a 3-year low, in fact. The Bloomberg index of the 50 most traded models fell nearly 6% last year, which is a continuation of a theme. Let's bring in Bloomberg reporter Andy Hoffman out of Geneva on this story. Andy, wasn't it just a few days ago that Rolex turned around and upped its prices? And we talked to you about this, and yet we've got the second-hand market, the used market, falling. Can you kind of put these two stories together for me? Is there the demand or isn't there the demand?
It's a very good question, Guy. Yeah, good morning. So, indeed, Rolex raised prices, with some gold models 8%, even 12 or 13%. We saw that to start the year. But we've seen used watch prices, the secondary market, prices fall again in 2024. That's after falling in 2023. They fell at an even faster pace that year. And in 2022, they really took a big dive. Now, these are two separate yet interlinked markets. Rolex makes about 1 million watches a year. The primary market is worth about $50 billion a year, we estimate. The secondary market, where we've seen all this action and negative price momentum, is worth about $20 billion a year. So there's a lot more supply, obviously, on the secondary market. There's a lot more trading going on. There's only so many new watches that people want, that people can buy, particularly for Rolex. With the secondary market, you can get pretty much any watch, any luxury watch that you want. The question is what you're willing to pay for it. And what we saw last year was buyers and sellers driving down those prices by about 6%, according to our Bloomberg Subdial Watch Index, and that's the 50 most traded watches by transaction value, mostly Rolex, some Patek, and a bit of Audemars Piguet in that index.
Andy, very quickly, geographically, who's buying this? Where is most of the growth coming from? Very quickly.
It's very similar to the primary market. The U.S. really drives this market. They're the big buyers, but the U.K. is a very sophisticated, strong market. Japan is a long innovator in used luxury watches. The Italians are the tastemakers always in the premium watch market. They're the ones who decide what's cool and what isn't. And so, yeah, it's quite similar. China, obviously, is a growing market, but as with the primary market, the Chinese economy and the Chinese buyers are a little subdued.
Well, certainly we'll see if that changes some of the stimulus being pumped into that economy. Bloomberg reporter Andy Hoffman on the latest on the watch sector. We thank you so much. So what did we learn today? We learned that, of course, China, the geopolitics is a little bit of an overhang when it comes to battery makers, when it comes to technology. At the same time, when NVIDIA and Microsoft are going full throttle into that sector. Later today, Bloomberg Technology will speak with Jensen Huang at CES in Las Vegas. That coming up at 4:30 p.m. UK time right here on Bloomberg TV. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
The U.S. blacklists Tencent and CATL for alleged links to the Chinese military, targeting the world's biggest gaming publisher and top EV battery maker. Now, Canada's ruling party begins the search for a new leader after the Prime Minister Justin Trudeau steps down. Former Bank of England boss Mark Carney says he's considering running. Plus, NVIDIA unveils new chips, software, and services in the race for AI supremacy. Now, in a few minutes, we'll be joined by Stephen Dainton, Barclays president and head of the investment bank management. We'll talk about the impact of Trump's White House return on markets, on the outlook, of course, for mergers and acquisitions, IPOs, and the outlook for Europe. But first things first, so let's take a look at the European markets map. Now, overall, a lot of the focus is, of course, on inflation data from Europe. Now, European equities, I guess, a little bit on the lower side. The FTSE down 0.4%. We're seeing similar losses on the FTSE MIB over in Italy, and the IBEX down 0.2%. The CAC 40 in Paris actually holding strong, 0.3% higher. Again, a lot of the inflation data here in this region will give us a clue on what the central bank does next. The ECB has always said that they will be gradual and quite careful in actually decelerating interest rates. French inflation accelerated in December, which supports that plan to be very gradual. A couple of other things we need to watch out for. Look, the broader markets, traders are still grappling with these extra sanctions against some of the Chinese companies. Donald Trump denying a report that he might moderate plans for across-the-board tariffs when he retakes the White House. All of that is playing out. Euro dollar 104.28, and then yen 157.41. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the race to replace Justin Trudeau is on after the Canadian Prime Minister said he's resigning after more than 9 years on the job. Now, the former Bank of England boss, Mark Carney, says he's considering a run. Trudeau will remain as Prime Minister until a new leader is selected.
I have always been driven by my love for Canada, by my desire to serve Canadians, and by what is in the best interest of Canadians. And Canadians deserve a real choice in the next election. And it has become obvious to me with the internal battles that I cannot be the one to carry the Liberal standard into the next election.
Now, for more on all of this, let's bring in Ross Matheson, Bloomberg's EMEA News Director. Ross, thank you for joining us. So is the race to replace, how is the race to replace Trudeau shaping up? Mark Carney is also now saying that he's considering to run.
Well, that's right. So it's shaping up to be very interesting. And the question for the Liberals here is, what kind of candidate can they have that can go into an election that could come in a matter of months, who could potentially not win the election, but at least mitigate the losses the Liberals might face, given they're trailing so badly in opinion polls? And is this a person who could put some daylight between the Liberals and their former leader, their outgoing leader, Justin Trudeau, and his policies, or someone with a strong economic record? So the main candidates potentially include Chrystia Freeland, who of course was finance minister until recently, and her resignation kind of set off this crisis. But she's not just been finance minister, she's been trade minister, she's been foreign minister. So she has a lot of name recognition inside Canada and a long track record there. Equally, she's had a very combative relationship over the years with Donald Trump, the incoming US president. She was seen until very recently to be quite close to Justin Trudeau. So would that work against her? Obviously, her replacement finance minister, Dominic LeBlanc, is someone else. And you mentioned Mark Carney, who has now said that he's potentially interested in the position, of course, the former Bank of Canada governor, chair of Brookfield Asset Management, also Bloomberg Inc. You know, he has close ties to the Liberal Party, and he's seen as influential in the party, and also a very long economic record, of course, many, many years at Goldman Sachs around the globe. So it's shaping up to be a very interesting race. The question is, who wants to be leader, and potentially for how long?
Yeah, Ross, I mean, the thing is that with the resignation, of course, this sets the stage for a pretty dramatic shift in the country's economy due to inflation. So the new leader, either way, will face a very big battle in the elections ahead.
Well, that's right. The election's going to be very interesting because it has to be held by October, and it could come in a matter of months if there's a confidence vote in the new leader, and that sets off this election. Of course, the Liberals trailing very badly behind the Conservatives, and the Conservative Party is really set to distance itself, you know, say that it is the party of, you know, Canada first. So the polar opposite of the policies of many years of the Trudeau government, which were very much about green policies, spending, heavy immigration into Canada, and saying none of those policies have been successful, including on the inflation front. So really setting themselves up as being completely at the other end of the spectrum, you know, going to shut borders, reclaim Canada, you know, for Canadians in a way, but also, you know, look at the policies around green transition, carbon tax, walking some of that back, and again on government spending. But really, it's been a similar story in Canada as it's been in the US. You know, the economy has not been very strong in Canada. Inflation has been a problem, and the government's really struggled to articulate its policies and what it's doing there around inflation. So for the incoming leader, you know, a suite of challenges, but also a big one, including how to deal with the big leader who's coming in next door very soon.
How will, Roz, of course, you know, U.S. politics and Trump's next term potentially play into all of this?
Well, you can see that Donald Trump isn't waiting to get into office to keep prodding Canada. It seems to be one of his favorite sports, including in his first term when he had a very combative relationship with Canada and Mexico and others when it came to trade. And we can see already Trump using the narrative. The US, he says, is subsidizing Canada's economy via trade. Whether that's accurate or not, that's a narrative that he keeps pushing. And he's been talking, of course, about tariffs on Canada, Mexico and others. And so that's going to be very difficult for a new leader to deal with, you know, to show that Canada is carrying its weight when it comes to trade. But you might find a Conservative Prime Minister, that's if the Conservatives get in, that there might be a bit more of a rapport there, especially when it comes to issues around immigration. They might be able to navigate some of that with Donald Trump a bit easier, given they'd be on the same page when it comes to that kind of harder right rhetoric on inflation. But certainly the US is going to loom large over Canada in the current administration that's coming in the US, particularly when it comes to trade.
Roz, thank you so much. Roz Matheson there, of course, of Bloomberg EMEA News Director. And a reminder, Mark Carney is chair of Bloomberg's board of directors. That's, of course, a disclaimer. Now, the U.S. has targeted the world's biggest gaming publisher and top EV battery maker, Tencent, and CATL shares closed firmly in the red after being blacklisted by Washington for alleged links to the Chinese military. Now, for more, let's bring in Bloomberg's Tom McKenzie. Tom, thank you so much for joining us again. There's a lot of AI and tech news in general. I mean, this was a surprise because it's so close to Trump's inauguration.
Yeah, and it illustrates those two names that you pulled out, that the producers pulled out, just the significance of this, given the size and scale of these companies. Tencent, this major producer, the world's largest publisher of games, but also a major investor as well, has acted in recent years like a venture capital firm as well, investing in multiple gaming companies around the world, including in the US. Now, Tencent, which has seen its shares hammered today on the back of this news, has said that it is going to work and with the Department of Defense. This is a blacklist for the Pentagon. So the immediate impact is that they are likely to be frozen out of any potential contracts with the Pentagon. Unlikely to have had any of those anyway. Tencent, they say they're going to work with the Department of Defense. They say they're going to try to initiate a process to get them removed from this blacklist. And that has happened in the past. Xiaomi is a company that was put on that list and then successfully sued to be removed as part of that blacklist. CATL, another company that you mentioned, is the largest producer of electric vehicle batteries. It has about 37% of total market share. Its biggest customer is Tesla. And so you think about the relationship between Musk and Trump, and that triangle, or at least that web of connections, is pretty fascinating, seeing that CATL, with investments in Europe and the US, is now on that blacklist as well. The other company, fascinating, is Costco, which is a major shipping company. It is the biggest shareholder in Piraeus Port in Athens, which is one of the largest ports, of course, in Europe. So the consequence of this, potentially significant. Right now, immediately, no legal ramifications for the companies. It's more of a tarnish of their reputation, and you can imagine more of them will probably fight to be removed off this blacklist. But it's also a reminder that this volatility, that this increased pressure on Chinese firms is likely to continue.
Yeah, and it's probably having an impact on the wider markets. Tom, thank you so much. Tom McKenzie there with the very latest on CATL. We'll speak to Tom later in the show about NVIDIA's new products as well. Coming up, we'll discuss the outlook for Europe with the incoming Trump administration, as well as geopolitical risks in the region with Stephen Dainton. He's Barclays president and head of investment bank management. That's next, and this is Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Well, Donald Trump's return to the White House is definitely dominating investment outlooks. The U.S. economy and assets once again expected to power ahead. But what impact will ongoing geopolitical uncertainty have? Well, to discuss his outlook for the year, we're joined by Stephen Dainton, Barclays Bank President and Head of Investment Bank Management. Stephen, thank you so much for joining us. It's going to be, I feel like my prediction is going to be very busy, giving all of our thoughts and insights into trying to figure out what Donald Trump does next. Does it change the outlook for investment banking?
Well, firstly, thank you for having me and Happy New Year.
Happy New Year.
I think, we've had an extraordinary 2024, and we should reflect for a moment. We had 76 elections in the planet last year. 80% of the incumbents are no longer there. The one that is dominating the thought process is obviously President-elect Trump. And I think the path of his work over the course of the next 6 months is really the appointments in his cabinet. We've seen many of those already. I think they become very important as to the policy direction. The second thing is obviously tariffs dominating conversations and its response. This morning, we're hearing about what is happening in Canada. But for Mexico and Canada, this becomes critically important for their path forward in 25 and 26, but also for the rest of the world. So I think tariffs becomes extremely important in understanding once he establishes his position in the White House. And then you move to taxes. What happens to the tax profile in America, the relevance of taxes both at a corporate level and also at a consumer level. So I think there's a myriad of things around his appointment yet to be determined, but have been very visibly shown to the market before that. So he is preparing for his incumbency very, very quickly.
But there's many people that expect that the incoming Trump administration will bring on new deals because of deregulation, because we'll see, a lot more hope for equity markets and the markets. Are you preparing for that? Does it mean more hiring in certain places or moving people around?
I think, first of all, you have to think about growth. And if you look at growth in the world, in particular, growth in the U.S. remains exceptional. We talk a lot about U.S. exceptionalism, but growth in the U.S. is exceptional. At above 2%, 2.5% this year. I think you will see a continuum of activity around M&A, in particular with the valuations that appeared during the course of last year. I think that will create a spectrum of M&A activity and capital markets activity, particularly in the United States during the course of 2025. I think what Europe has to find is growth. And I think we talk extensively about the pathway of a growth above 1%. And I think that even the Draghi plan gave you a framework of how to achieve that. But you have to see Europe coalesce together, difficult with the current malaise in France and in Germany. That will become clearer, obviously, after the election in February. So I think that growth becomes the critical path.
I think the Draghi report was calling for $800 billion for an investment, which is also where do you find the money?
Well, you look at debt loads in Europe, that's going to be, Madame Lagarde has a huge opportunity to continue that pathway from a monetary policy perspective. But debt loads in Europe are a problem. Right. Reinvigorating entrepreneurial growth, capital, attracting capital, and if you look at the dollar and inflows into the U.S. last year, the U.S. is attracting a huge amount of capital, whether that's public capital or private capital, which is emphasizing the pathway for the dollar. I think Europe has to find that path of entrepreneurs to attract capital into Europe.
And then, of course, there's a specter of inflation, which we saw with the French numbers as well today. Do you worry about that?
Of course. I mean, it's the single biggest danger, I think, for 2025. If you look at the pathway, not only in Europe, and you'll see some inflation statistics coming out of Germany and out of France during the course of this week. I think when you look back at inflation in the U.S., the key for Chair Powell is establishing a route to a 2.5% to 3% narrative. I think if that comes with growth, that is okay. It's where you have inflation that does not have an attendant growth path aligned to it. And unfortunately, that is the pathway that Europe might be following this year.
And tariffs, add tariffs to that, and then we're in trouble with inflation.
Well, I think the clarity around tariffs is changing.
Right.
So I think previously it was 10 to 20%, 60% on China. That narrative seems to have adjusted over the course of the last 24 hours. we'll really get a pathway. And remember, this is something that the president-elect can enact on his own. He does not need congressional power or the House to give him that authority. So I think the clarity around tariffs will become much clearer very soon in the evolution. Important, obviously, for China. The pattern of market activity this year actually is not dissimilar to the start of last year, where you saw Western markets, in particular the US, accreting very, very quickly, predicated on the growth aspects of the US, and the Asia markets actually compressing. They recalibrated later in the year, and I think we have to see, number one, the pathway of what Trump actually wants to put in place, and then the response to that from the Chinese authorities and the European authorities post that.
There's always retaliation. Stephen, don't go anywhere because we'll talk about the UK next. Okay. Stephen Dainton, Head of Investment Bank Management at Barclays, stays with us, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcome back, everyone. Now, the UK 30-year bond yield climbed to the highest since 1998. This is a huge deal when you look at Bank of England expectations that significantly also repriced about 3 weeks ago. Still with us exclusively, Stephen Dainton, Barclays Bank President and Head of Investment Bank Management. Stephen, I mean, this is partly inflation expectations, what we're expecting for gilts, very linked to what the Bank of England can deliver. Are you optimistic on the UK?
I think we have to be. We talked earlier about growth. The UK is muddling around 1%. I think the new government have laid out a clear strategy for growth, evidenced in the budget. Obviously, there was a number of concerns around that, but I think we've navigated that pretty effectively.
I think we have to find growth in the UK that comes from innovation and investment. Actually, at Barclays, Venkat laid out our CEO laid out a new strategy in February of last year that had a material commitment to the UK, actually £30 billion of new capital into the UK. And I think that is a very clear commitment from us towards our home market. That being said, obviously, we're diversified as a bank, but the UK itself has to find growth. And I think that with Governor Bailey, there is a good chance we have a pathway that will be relatively simple from the Bank of England over the course of the next 12 months. They've been clear about a dovish path, and I think that that's very helpful.
Stephen, a part of also this new strategy was basically focusing on the investment bank's relative share of the company in order to boost returns. How's that going?
I think we've executed well over the course of the last 12 months. We're a very diversified operation within the IB. We have geographic diversification. Of course, we're substantially relevant in the United States, that post the Lehman acquisition, post GFC. But we are globally diversified. And actually, from an asset class perspective, we're also very diversified. So really, from February of last year, it becomes about execution. That pathway was executed well during the course of last year. I'm very hopeful that we see a pickup in capital markets activity, whether that's ECM or DCM. Last year was a very substantial year for DCM. You had record amounts of activity in investment grade. Actually, it was the second highest year in investment grade issuance in the United States last year. But I think that capital market cycle in equities and in M&A will evolve during the course of 2025. Importantly, I think driven perhaps by the multiple divergence that you have in the US and in Europe. And corporates themselves are restructuring actively, whether that's the boards themselves making a conscious decision to restructure, and or you have a higher level of activist activity in and around boards this year.
And Stephen, how are bonuses looking?
Look, I think that it was a constructive year last year. Nothing is finalized for us, but I think it was a constructive year from a capital markets perspective. I think really it's about looking at the activity levels in markets and in banking, and I think that was relatively constructive last year.
All right. Thank you so much for joining us. Stephen Dayton there, Barclays Bank President and Head of Investment Bank Management. Again, in the last couple of minutes, we actually had the 30-year bond yield, gilts in the UK, climbing to the highest since 1998. And of course, this is due to concerns on the country's debt level. Now, coming up, Europe burning through gas reserves at its fastest pace since 2018. We speak with Goldman Sachs' EMEA Head of Natural Resources Research. That's next. And this is Bloomberg.
In case you missed it on Bloomberg Bloomberg, The China Show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss The China Show live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacroix here in London, and these are your top stories. The U.S. blacklists Tencent and CATL for alleged links to the Chinese military, targeting the world's biggest gaming publisher and top EV battery maker. Canada's ruling party begins the search for a new leader after the Prime Minister, Justin Trudeau, steps down. The former Bank of England boss, Mark Carney, says he's considering running. Plus, NVIDIA unveils new chips, software, and services in the race for AI supremacy. Now, a couple of breaking news in terms of markets. The UK's 30-year bond yield actually climbed to the highest since 1998. Now, this is due to concerns over the country's debt pile, the government spending plans, but also near record borrowing levels have really led the sell-off in gilts, causing the benchmark 10-year yield to rise also about 40 basis points since October. The UK, a reminder, is set to auction £6.5 billion of gilts this week. That puts pressure on the Chancellor to keep the market on side and avoid breaching her fiscal rules. So you can see what the 30-year yield has been doing over the last couple of decades. Now, Europe burning through gas reserves at its fastest pace since 2018 as the cold weather ramps up heating needs across the continent. Now, the rapid depletion could pose a challenge to stockpiling ahead of next winter and risks impacting short-term prices. Well, joining us now is Michele Della Vigna, EMEA Head of Natural Resources Research at Goldman Sachs. Michele, thank you so much for joining us. It's January, it's cold. How do you see this developing? And good morning.
Thank you, Francine. Same to you. It's a fascinating time because we are seeing at the same time the interruption of the gas flows through Ukraine, but most importantly, we're seeing temperatures which for the last 2 weeks are forecasted to be 4 degrees lower than average. That's something we haven't seen in many years. And that's what's prompting this increased demand, which is bringing to this very, very quick use of the current stocks of gas. We do not think we are running the risk of not having inventories at the end of winter. Remember, that was the big fear back in 2022. We don't think that's going to be the case, but without doubt, we're going through a period of great tightness. And we may even, if the winter continues to be cold, to test the switch to fuel oil and to diesel, which could bring gas prices further up. We think the switch to fuel oil happens at 60 euro per megawatt hour, to diesel at 80 euros per megawatt hour. So we can still see prices rallying further, but we don't think there is a risk that inventories draw well below 30% by March.
But Michele, if you look at the gas reserves and the fact that they're depleting, I think the storage sites are only 70% full compared to about 87% at the same time last year. Does it mean that prices will go up?
I think the risk is definitely to the upside, and it also means that prices will remain higher during the summer because we will need to attract more and more LNG into Europe and take it away from Asia, which is the most price-sensitive buyer. So definitely, I think a strong outlook for gas throughout 2025. I think we have one more winter, which is tight, which is the next winter. But after that, there's really rays of hope for Europe because the extraordinary buildup of new liquefied natural gas exports from the US and Qatar will come to Europe and will, I think, save Europe from having another winter like this one with a tough gas pricing outlook.
I mean, there's also this fragile balance between, of course, spark price swings because of some of the unplanned outages. What can you tell us about what, away from stockpiling, how outages are across Europe at the moment?
So we are having some outages in Norway, but most importantly, we are having low winds, which really impacts the offshore wind production, especially in the UK. And this, I think, reminds us one more time that the more renewables we build, the more backup we need to have. And that's why I think natural gas, available, cheap natural gas, remains absolutely a key fuel for many years to come, for times like this one, when the temperature is below normal and at the same time wind doesn't blow into the North Sea.
Michele, what can you tell us about the fact that, Russia and Ukraine have ended these 5 decades of gas transit to Europe? Are countries individually or as a bloc finding and needing to find more gas resources from elsewhere that's more expensive?
Without any doubt. We started the process of diversification of the European supplies 2 years ago. That process continues. I think it's going to go well because so much LNG is going to come to Europe, mostly from the US, which is also going to help, by the way, in terms of trade with the US, because we're going to become by far the biggest importer of US LNG, but also from Qatar and from other countries. So the buildup of LNG is what ultimately will free Europe from the constant fear that a cold winter will mean that energy becomes unaffordable.
I mean, Michele, of course, the stoppage is slashing Russia's revenue, and at the same time, it's depriving Ukraine from some of the transit feeds. Does this significantly change the energy landscape in Europe?
I think the energy landscape in Europe definitely structurally changed when Russia stopped sending gas through the Nord Stream pipeline and the Yamal pipeline. This is the last straw, and I think this is why LNG is becoming so much more important for the global gas market and for Europe in particular. When we think about the Russian budget, the European gas exports matter, but to a limited extent. What matters the most is the global oil exports. And as long as they continue to export, ultimately their budget will be fine. And this is why I think this will have a minimum impact on the Russian budget, but it certainly has shifted and changed the energy landscape for Europe. And again, we need to wait 2 more winters, but the LNG is coming and Europe ultimately will regain cost competitiveness in energy, something that we've lost 3 years ago.
Michele, gas prices seem to be up about 50% year on year. How much further do you think they have to go?
So we believe if we need to go to fuel oil switching, which will be the case if the weather remains cold, we could go to 60 euros per megawatt hour. So that effectively would be another 20% increase from here. We could also build an extreme case, but I don't think we will get there when we need to go to diesel switching, and that would be 80 euros per megawatt hour. We don't think we're going to get there, but if the weather remains cold, we could see further upside in European gas prices in the near term.
What do you think will materially change for energy, Michele, over the next 6 to 8 months? We have a new commission in place. There's a lot of question marks, of course, on renewables going forward. There was a rather bizarre conversation between Donald Trump and Keir Starmer on renewables, especially in the North Sea. Does that change how Europe views renewables and therefore, gas and energy?
I think there's three changes that we need in Europe. The first one is the realization that we need a better infrastructure and especially much better connectivity between the north and the south. We need to connect the wind from the north with the sun from the south, especially from the Iberian Peninsula. So investment in grids and connectivity, I think, should be the #1 priority of the energy policy of Europe. Second, I think the buildup of renewables will continue. This is not just driven by ESG and green desire. This is what makes economic sense for Europe. But thirdly, we also need to realize that gas is a key backup for this infrastructure, for the seasonality and intermittency of renewables, and we need more reliable gas. And that's why we need the LNG exports from the US and from Qatar that will start really to ramp up in 2026.
Michele, thank you so much for joining us to get us started, of course, for the year ahead. Michele Della Vigna, EMEA Head of Natural Resources Research at Goldman Sachs. Now, higher fuel costs are weighing on European inflation. It may be a reminder to ECB policymakers that while their 2% target may now not or might now be in sight, it's not yet within reach. Now, French inflation accelerated to 1.8% in the year to December. We'll get the euro area reading at 10 a.m. For more, let's bring Bloomberg Economics Chief European Economist, Jamie Ross. Jamie, thank you so much for joining us. I mean, it feels like the ECB has always said, steady on, we're going gradually. I mean, do they worry about tariffs, or is it just an underlying structural concern about inflation being stickier?
Well, I mean, I think the Governing Council is pretty neatly divided between the hawks and the doves on these issues, right? So if you look at tariffs, it's possible that they could be inflationary if Europe retaliates against the US, and the hawks certainly cling to that perspective. But the doves are more of the view that it will be disinflationary because it would slow demand globally and therefore push down on prices. I mean, I think you can pick your side. You can see it from both angles. I mean, for us, certainly the most immediate impact is just via higher uncertainty. That's going to be, are you going to really build a factory if you think there might be a 10% tariff on your exports? Possibly not. So you just wait, and that's the main channel through which the economy is being affected right now.
But apart from services, everything else is moving in the right direction. Again, what I keep on hearing from a lot of central banks is the last mile is the most difficult. Is that because of the specter of Donald Trump policies, or would it have been the same without Donald Trump?
No, I don't think it would have made too much difference. To the near-term outlook for inflation, I don't think it really matters. No. I mean, services inflation is a bit too fast. It's like 4%. It's been 4% for ages. And that's the thorn in the ECB side. And I mean, I guess with the energy stuff that we're seeing now, and the main reason that inflation is going up in Europe again is energy. It's nothing else. Services is flat. And the ECB, I mean, they've learned from the last experience that they don't like energy prices going up because then it gives people something to fight over when it comes to wage negotiations. So they will be a little bit cautious. I think market pricing of just straight cuts through to less than 2%. I think that's probably a little bit too optimistic on what they'll be able to do. I think when you get to March and the neutral rate is like you're in that territory, I think they'll probably start to slow down.
Jamie, we had big markets news on the UK today, that 30-year gilt rising to 5.19, the highest level in over 25 years. And this is because of concerns on the country's debt pile. And this week we have about £6.5 billion of gilts this week. I mean, is there a debt problem in the UK, but also elsewhere in Europe?
Yeah, I mean, I slightly take issue with the idea it's all about UK debt. I mean, if you look at global bond yields, they are all extremely highly correlated, right?
Yeah.
So, I mean, if you look at US treasuries, they've moved in exactly the same direction. There is a global sense that the natural rate may be higher, that interest rates won't be able to come down as fast, or to that lower level that we might have previously expected. And this is transmitting across the globe. And of course, countries with very high debt are vulnerable to expectations of interest rates. And that's our biggest problem.
I mean, this is the thing. There's nothing new. There's no new news. I guess you just have to keep markets on side, or it could spell trouble ahead.
Yeah, I mean, we are going to... If market pricing sticks, then, the fiscal rules are probably going to be breached in the UK, and they're going to have to come back and do more, which is what they've already tied their hands by saying they're not going to come back for more. It's all a bit silly, really. But I mean, I think the main point is that, yes, it's going to hit us. We're going to have to pay higher interest payments, and that's a problem that everyone has to face up to.
Jamie, thank you so much. Jamie Rushler, Chief Europe Economist for Bloomberg Economics. Coming up, a packed arena in Las Vegas as the NVIDIA Chief Executive pitches his vision of how AI will spread through the entire global economy. Details next, and this is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Well, the NVIDIA Chief Executive Officer, Jensen Huang, has announced a raft of new chips, software, and services aimed at staying at the forefront of artificial intelligence computing. Well, Huang presented the new lineup during the CES show in Las Vegas.
We used GeForce to enable artificial intelligence, and now artificial intelligence is revolutionizing GeForce. Everyone, today we're announcing our next generation, the RTX Blackwell family.
I mean, it's pretty compelling. It's the kind of thing that you really want to be at and have a look at. Pre-market, NVIDIA gains 1.6%. Let's bring in, of course, Bloomberg's Tom McKenzie. I'm a bit jealous of his jacket.
The sparkly leather jacket.
Looks fabulous in an arena. But on serious matters, they unveiled a new graphics card.
Yeah, so he was talking about this GPU, and it's a bit of a nod to the history of NVIDIA, which, of course, started off by being a gaming company creating chips for gamers. And that is what they then repurposed for artificial intelligence. He's going back to that, releasing a new gaming chip, but underpinned by their AI accelerator technology, the Blackwell technology. So this is good news if you're a serious gamer. I'm going to make the assumption that maybe you are not, Francine, but nonetheless, important. It's important for revenues as well.
We'll keep that a secret.
We'll keep that a secret for now. It's still important for revenues. They get about $11 billion in terms of revenues from the gaming part of the pie. Much smaller, of course, than data centers now. Data centers has eclipsed that. It's about $100 billion US. The other thing he really stressed was the opportunity that he sees around physical AI, so robotics. He sees that as a potentially multi-trillion dollar opportunity. Robotics, embedding AI into robotics, embedding AI into autos and cars as well. And you saw that with that tie-up with Toyota. So that was another key thing that came through from this in terms of the opportunity they see around automated factories, automated cars, and humanoid robotics as well into the future.
So it was really interesting because he put the focus on Cosmos and other models, not chips. Why?
Well, this is a reminder that NVIDIA doesn't just do the hardware. It doesn't just do the chips, it does the software as well. It has the CUDA software, CUDA software that goes with its AI accelerators. But at the speech, as you say, he also announced this Cosmos Foundation AI platform trained on videos, tens of millions of videos, hundreds of millions of videos, that they can then push out to developers who can build their own models on top of NVIDIA's foundation model. So it's a reminder that NVIDIA is not just pushing from hardware into software, but also trying to integrate into different segments as well. So that's the importance of this call around Cosmos, and we'll see to what extent it's picked up by developers and how constructive that is going forward for this business.
I mean, it was a pretty incredible show. He spoke for 90 minutes.
Yeah.
I mean, the arena was full. There was clapping. I mean, it was like Taylor Swift talking AI. He also talked about tie-ups with Toyota and MediaTek. I mean, does that really change how some of these companies go forward if you can get, something with NVIDIA?
Well, you see, every time he name drops a company that they're partnering with, you see the movement up in the share price. MediaTek being one of those names. As you say, Toyota getting a lift. The share's up the last time I checked about 3% on the back of that news. So that is the reminder of the power of this business right now in terms of moving the fortunes of companies with which they tie up. Toyota then, that will be into the future an autonomous project with NVIDIA. You can expect to see, for example, displays in your cars of the future that will be monitoring your facial recognition or facial expressions to make sure you're not falling asleep at the wheel, giving you live data around road conditions. Those are the kind of things that go into the future in terms of that partnership. But again, in terms of how they tie up with other businesses, the impact that has and how foundational that is. And yes, the hall was packed, people were lining up outside. He was donning the sparkly leather jacket. I know you're putting a purchase in for one of those as we speak. But and the enthusiasm. Interestingly, of course, we were hearing from Microsoft's Satya Nadella. They have a deep partnership with NVIDIA, of course. They rely on their chips, and he was talking with great enthusiasm about the opportunities that they see for AI going forward with that $80 billion capex spend from Microsoft.
Tom, thank you so much. I will definitely be wearing a very similar jacket on the Pulse, I think, very shortly. Our Tom McKenzie there with the very latest on NVIDIA. Now, a little bit later today, we'll also be speaking with the NVIDIA Chief Executive, Jensen Huang, at CES in Las Vegas for Bloomberg Technology. I think that's Ed Ludlow, and that's at 4:30 p.m. UK time. Coming up, the uncertainty surrounding Trump's tariff policies is expected to lead to further volatility in the dollar and currency markets around the world. We'll discuss that next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
The euro has kicked off the year on a good note, and hedge funds see it hurtling towards parity with the dollar, if not lower in the coming months. Now, for more, let's bring in Aline Oyamada, Bloomberg's Europe FX and Rates editor. Aline, thank you so much for joining us. I mean, there's quite a lot going on in euro-dollar because of dollar exceptionalism and then concerns about the way forward for Europe.
Yes, like you said, there's a lot of pessimism around the euro at the start of the year. To be honest, it started when Trump was looking like the winner of the election back in September, October, and since then the euro has been very weak. But what we are looking for now is euro parity. This is an event that has only happened a handful of times, and we were just at 1.04 against the dollar, so we got to as low as 1.02, so we could get to 1. And we have some big names saying that it could happen as soon as this month, maybe this quarter, the latest. Hedge funds also have been piling on that trade. When you look at options, there's quite of a big chance of that happening this month. And I think it all talks to, one, the dollar strength, obviously, but also Europe's situation. The economy is pretty weak. We saw some uptick in inflation recently, but that doesn't change the broader outlook for the ECB, which is cutting rates more aggressively than the Fed.
I mean, the concern with dollar is that all things pointed to be stronger, except Donald Trump wants a weaker dollar. So that's going to be, you know, a possible source of tension.
Yeah, and that's what we saw yesterday with the manic market reaction to the trade tariffs stories and then Trump pushing back. I think the market is convinced that his administration will end up in a stronger dollar, but because it's a consensus, then there's also the risk of a reversal, which is why I think we saw yesterday the dollar ending the day weaker, even though Trump denied that report of narrower tariffs.
I mean, what would you expect for yen?
So the yen has been also on a weak note. The main thing there is the BOJ. When will the next hike come? There's some expectation that it could happen this month, but there's a lot of doubt as well. And the BOJ hasn't firmly signaled that they will do it. So that's why the market has still like a bit cautious on betting on a stronger yen. Yesterday specifically, we saw some outflows from retail investors that kind of aggravated the situation there. But until we see like firmly signals that the BOJ will come with more hikes, then I think it will remain on the weaker foot.
And then one of the big market stories, of course, that 30-year yield in the UK. And that's all concern about debt because there's quite a lot of bond auctions.
Yeah, I think debt is the main concern right now. The Labour government has announced last year that they will sell a near record amount of bonds this fiscal year. And the debt is already pretty high, so there's this whole concern on who will buy those bonds and at which level. Today we have a 30-year auction coming very soon that will be kind of a test of that demand. And at the same time, yields are being hurt by the market pairing expectations for interest rate cuts from the BOE. So two factors playing against yields.
A lot to watch out for. Aline, thank you so much.
Yeah,
Aline
of course.
Oyamada, there, Bloomberg's Europe and FX Rates editor. Up next, Bloomberg Brief, Danny Berger and Manish Krani in New York. That's it for The Pulse. Have a great day. A lot going on in terms of markets. We also look ahead to any Trump news. This is Bloomberg.
First time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
The great unveiling. NVIDIA aims to expand its dominance in robotics and autos after closing at another record high. Mounting tensions, Washington hits Beijing hard, blacklisting multiple firms across industries from tech to oil. And Mark Carney throws his hat into the ring in the race to succeed Canadian Prime Minister Justin Trudeau. Menace, some breaking news.
Danny, good morning. Yeah, we have breaking news. Euro area preliminary CPI comes in on the headline at 2.4%. The estimate out there was for 2.4%. On the core, I can tell you 2.7% year on year and plus 0.4%. Of course, the euro's had a blinding start. We were just looking at this before we came on to the 5 days in a row. We've had a rally in the euro up 0.7%. As much of that, Danny, is to do with the dollar shifting around. Equity markets is what we've got for you. We're on this tariff roller coaster. 25 hours ago, we had this explosion higher in risk on the Washington Post story that we're going to have narrow tariffs. Trump walked it back, but we still eked out gains as we went to the close. Goldman Sachs still say that there are opportunities here in this market, short-term buying. Of course, we're dealing with the new list of blacklisting here in the United States of Tencent and CATL versus NVIDIA. Let's roll it over, have a look at the bond market. Danny, yields popping, and they were popping before the tariff headlines yesterday. 30s trading at a 14-month high. We come back to flat at 462 this morning. Are we in a secular rise in interest rates is a question that Jim Bianco asks.
Some other stocks we're keeping our eye on, or maybe the same stock that we're literally always keeping our eye on. NVIDIA, a new record high yesterday, and then it announced new chips, software, and services, trying to stay ahead in AI computing, in autos, in robots. That's up 1.3%, Menace.
Caravana jumping after RBC Capital Markets upgraded the stock to outperform from sector perform, saying that the used car retailer remains well positioned to achieve 25% plus growth in annual adjusted EBITDA.
And some more sell-side action for you. PepsiCo rising after Piper Sandler initiated coverage of the company, along with other soft drinks, including Coca-Cola, Dr. Pepper, with a recommendation of overweight.
And in just a few moments, we'll begin the conversations on these markets. Mads Pedersen of Human Edge Investment Technology. A little bit later this hour, what to do with your stocks. Katrina Dudley of Franklin Templeton. Go for breath.
It's a difficult market to try to navigate. I think one of the more interesting things, Manus, and you pointed this out, even though you had Trump denying that Washington Post story that seemed to suggest that tariffs would only be towards critical goods, you still had dollar weakness and euro strength. Ozan Tarman of Deutsche Bank puts it really well, saying that it shows just how one-way and heavily positioned this market is, that you can have Trump walking things back and still people selling the dollar and putting on euro positioning.
And that dollar, it was like vertigo. It dropped by over 1%. The question is this: are you in a higher for longer scenario? Do you think that tariffs will last longer? And those are the two questions, I think, that really irked the market yesterday. It was an explosive hour for risk on. Equities drove higher. The dollar drove lower. Let's just take a look at the dollar over the past 2 days, because it really contextualizes everything. If it is a shift in policy, trade policy uncertainty. Danny, let's have a look at this. Trade policy uncertainty really ratcheted higher. A lot of that work was done in November time, back to the 2019 highs. Let's take this proposition to Mads Pedersen, our guest this morning, CIO, Human Edge Investment Technology. So Mads, 25 hours ago, it was a reshuffling of the risk deck. When you look at that spike in uncertainty, in that trade uncertainty, and what happened yesterday morning, does it shake you in any way in your confidence to deploy new capital to risk markets at the start of this year?
Well, I think it confirms what we will have to live with Trump, which is that Trump sets the agenda, and this is a risky time to deploy capital. It's going to feel uncertain, but we're in a strong and very beautiful technology-driven growth boom. So you should deploy the capital, but you should not expect to get a year like last year or the year before. But there's still significant upside if the growth story is left in peace to unfold. It will not be left fully in peace. People will obviously make a name out of themselves speculating against what Trump will do. Trump will answer them back, put them back in place. And the special thing with Trump is he will also change his mind on the way. So you need to keep your focus on what you know, use your intelligence to find out where the world is, and navigate this uncertainty. But there's definitely more upside in markets from here if you look at a horizon of 3 months or if you look at a horizon of 24 months. There's definitely more upside.
The thing that's kept working, Mads, in this market is not just U.S. stocks, but is large cap. It is Mag 7. And you've seen this effort by the tech community, maybe to try to insulate themselves from the politics. Yesterday, we learned that Meta was adding the UFC's Dana White to their board, who is a Trump donor, who is a Trump supporter. Does that kind of political move, along with just the narrowness of breath, mean that tech can continue to serve kind of as this oasis in moments of turbulence?
Well, it's one of the legs. I would broaden the scope a little bit on the hiring. Mr. Zuckerberg has proven to be a nimble and very smart operator, and Dana is not only a Trump supporter, he's also an entrepreneur who created well, it's not really a sport I follow a lot, to be honest, as a Danish, but it's an impressive business he has built. Yeah, he's an entrepreneur who's built it. So we will see that the leading people with the most resources in the world will be hiring the smartest advisors. That's clear. I think Marcus Aurelius did the same many years ago. So there's nothing new about that, and I think that trend will continue. I think we will see it in other companies as well. And we have, of course, already seen it in many of the technology companies. It will not insulate them fully, but the use of the technology and the widening pickup of the artificial intelligence and of the cloud computing will provide the revenues, which will make it affordable for them to expand their influence.
Mads, I love your phrase, a beautiful boom in technology. It's a question of whether it will be allowed to continue or interrupted. It could well be that the yield market, the longer end of the market, interrupts the beautiful boom that you have for technology. My question to you is this: do you feel that we are moving into some kind of a new secular rise in interest rates? We've had a number of notes hit the inbox, 5%, 5.5% from various people. Porrick Garvey over at ING talking about this momentum. What is the injurious level of bond yields for you to the growth, that beautiful boom in tech stocks?
Well, going to 5% from here, after we went from 2 to 5 is like a tiny detail. So maybe they should find a stronger story for such strong words. But I think 5.5 is where it starts becoming a problem, because then it starts really slowing the economy. And if we at the same time have that Musk actually does something about the spending, which what they don't talk so much about in the US is how much the actual fiscal spending has been stimulating the economy. So if you get yields going up at the same time as you have a clamp down on government spending, then we can get a recession. And then we have another beautiful trade, but that's going long the US 10-year or the 7-year. Yeah. So I think to 5%, we're fine. It's not a big move from here, and the economy is strong. You know, the US economy was supposed to slow last year. We didn't see much of a slowdown. And the drivers, the technology spending is there. And one of the men with the largest budget in the world was out yesterday and telling how he's going to expand his investments into new areas. So there's a lot of strong growth coming from profits being spent, which can, you know, NVIDIA and Microsoft, they're going to spend independent of yields being 5 or 5.5. But of course, the marginal consumer is not. So that's probably at 5.5 the balance is.
Mads, this seems to be a global moment of turning away from duration. In the US, you had 30-year yields reaching their highest since November of 2023. In the UK today, it was the highest 30-year yields since 1998. Japan is somewhere around the highest since the 2010s. What do you make of this moment? The fact that it's not just the US and the deficit concerns there, but it's a global disgust of duration.
I think we are all a little bit scared. If I use myself as an example, if you had asked me 6 months ago how long my duration would be now, and you compare it to what is my duration, you know, in some of my portfolios, I have 100% equities, but in some portfolios, we, for various reasons, typically client restrictions, have maybe 70%. There, I would have thought I had longer duration. But given how erratic this central bank communication have been and the volatility that has put into the market, we just have to realize that we thought the central banks had come to a calm place, and then Powell goes out and make references which makes us think like he behaves a little bit like Biden, and the yields move around crazy, and it's just too risky to have long duration. I would have thought I had longer duration now than I have. I got it. I just have to correct my view because it's more dangerous.
Mads, I have a feeling we're going to continue to have these conversations in 2025. Always a pleasure to have you join us. Mads Peterson of Human Edge Investment Technology. Thanks for your time this morning. Let's get to some other top stories now that are trending on the terminal. A person familiar tells us that Bridgewater has dismissed 7% of its workforce in order to remain flexible when hiring talent. The cuts will affect about 90 employees. That means that the headcount is now back to where it was in 2023. Bridgewater will continue to hire selectively.
The International Longshoremen's Association and employers will meet today to negotiate a new labour contract with just over a week to work out the new deal. The main point of contention is the semi-automated cranes at the port terminals.
Fed Vice Chair for Supervision, Michael Barr, plans to step down from his role on February 28th unless a successor is confirmed. His departure raises questions about the future of the landmark bank capital proposal, which he was key in negotiating. Barr plans to continue to serve as a member of the Fed's Board of Governors.
Coming up, 10-cent dips, both in Hong Kong and here on the ADRs, as the U.S. added the Chinese tech company to the blacklist. More on the story in just a moment.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. The U.S. has taken the provocative step of blacklisting some of China's best-known companies, including Tencent and a major supplier of Tesla's battery, along with its biggest shipping line. Shares of Tencent were down 7 1/3% over the company's inclusion yesterday, on a U.S. Defense Department list for their purported ties to China's military.
Well, Tencent says in response that it's neither a Chinese military company nor a contributor to the Chinese defense industrial base. And although the sanctions have no impact on their businesses, they will nonetheless work with the Department of Defense to address any misunderstanding. Joining us now on this story is Rosalind Matheson. Tencent firmly denying the charge there. You've got to ask yourself, why now? I know this is a yearly list that comes out, and so therefore we should be prepared for it, but it is quite a contentious time. These are two very big companies, and Tencent has a swathe of holdings here in the United States of America, from music industry, Epic Games, Warner Music. So why now? Why these companies?
Well, it's interesting, as you say, this is a regular updated list, but a growing list from the Pentagon of companies that it's blacklisting. And it's a whole range of accusations, from direct ties to the military, direct ownership by the Chinese military or the government, or that they're simply somehow supporting the defense industrial complex in China between the private sector and the military. So it can really be a whole lot of different things that they're being accused of. And in this case, as you say, both companies say this is a mistake. They don't have any direct ties to the military or the government. But US officials point out that many Chinese companies are compelled to share information with Beijing, particularly when it's deemed to be relevant to national security. So it's very hard to escape some kind of broad, net here that they're casting from the Pentagon. As you say, this list keeps growing and it keeps getting bigger and bigger companies. There were other companies included again, but Tencent and CATL, two of the biggest ones. Tencent, as you say, fingers in many pies in the US and beyond. CATL is a real important part of the global supply chain for EV batteries for the auto sector, including Tesla in the US, including Ford, including many big European automakers. So it's interesting to see the timing of this. This doesn't mean that these companies get sanctioned, but it's really about saying to their buyers, for a better word, don't do business with these companies.
Well, the interesting thing with CATL specifically, Roz, was that they tried to build a factory in America, and it was shut down because of security concerns. Instead, they went to Spain and recently broke ground there. But that's the type of deal that it seems like Trump would want, to have these kinds of companies, foreign or otherwise, come in and under the tent of the U.S. and build there. How is Trump likely to handle some of these companies, ones, again, that have shown their willingness to come to the United States and to build and to hire?
Well, this is going to be the very interesting thing. As you say, the timing at the very tail end of the Biden administration, and with Donald Trump, soon to be inaugurated for a second term, how does he react? Because generally he takes a hard line on China. Generally, he's threatening tariffs as a whole on the economy, but he may also listen to Elon Musk when it comes to CATL, in particular, given the link for Tesla when it comes to EV batteries. But also, he's been shown to shift his view. We all know that he was very anti-TikTok in his first term in government. Now he's requesting to delay a bill that would force the sale, potentially, of TikTok from its US parent. And now he's saying, well, I can probably do a deal here that would benefit all. So when it comes to China, it's not just a blanket move from Donald Trump. It could be very interesting to see how this plays out.
That is the understatement of the century. Roz, thank you so much for joining us. Roz Matheson. Some breaking news to bring you from Semaphore, reporting that Mickey Bowman is the top candidate to replace the Fed's Barr as the chair of bank supervision. This is the key line from the story, Manis. Initially appointed by Trump, Bowman was an executive at her family-owned community bank. And key here, her views closely align with the deregulation agenda that took several years into Trump's first term to begin implementing. So this would be a deregulatory pick, Manis. It is also one that just highlights that the chair, the supervision, because Barr is stepping down, needs to be from someone who's already serving as a governor of the Fed.
And look, this plays into the wider narrative in terms of where do you want to be deployed in terms of capital. KBW index ramped by over 2% yesterday on the news that Barr was stepping down. So this is about a sea change in terms of regulation, potentially in capital, and we can discuss that with Katrina Dudley in just a moment. Coming up, we're going to talk more about, yes, you got it, NVIDIA. It's what we do every day, but stay tuned because this is the latest moves by the chip giant. Context matters every day on Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice, my conversation, my poetry, you know.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
In case case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot, by the
on
way.
beer and groceries and gas and video games.
And
I wish I had
hogs.
kept it. I wish I would buy a Harley today if I had.
Yeah, but you
that
probably wouldn't
Bitcoin.
be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and a beer in my hand.
Don't miss the next Open Interest.
We used GeForce to enable artificial intelligence, and now artificial intelligence is revolutionizing GeForce. Everyone, today we're announcing our next generation, the RTX Blackwell family.
That was NVIDIA CEO Jensen Huang on stage at the CES trade show in Las Vegas. The stock rising pre-market this morning after closing at yet another record high as Huang announced new chips, software, services aimed at keeping the AI darling at the top of the industry. How's he going to do that? Tom McKenzie has been tracking this story. We know that he's been monikered as the godfather of AI, but this is about stepping into robotics. It's about stepping into the auto industry, and it is about the evolution of what they're already doing, isn't it, Tom? Good morning.
Morning, Manus. It's about all of those things. This is about Jensen Huang. This is about NVIDIA spreading their bets. He talked a lot, of course, about sovereignty AI last year. In the speech at CES, it was packed. He was wearing that sparkly leather jacket, as you saw. He talked about the need and the opportunity around physical AI, and he released that chip as well. Not an AI accelerator chip, but a chip that's built on the Blackwell AI accelerator technology that will bolster your gaming if you're into that manner. So that's the GeForce announcement, but also the software component as well and the foundation model piece of the pie. It's a reminder that NVIDIA doesn't just do the chips, it does the software as well. It has the CUDA software that accompanies those AI accelerators. He also announced that they would be pushing out a foundation model that would assist programmers in developing and codifying their own models to help embed AI into robotics, into, for example, automated warehouses. Again, he talked about physical AI as being a multi-trillion-dollar opportunity. Bank of America says, though, they need to make sure that the costs are down in terms of the components to go into this, they have the efficiency, and then they can be pervasive enough to really create a new business line for NVIDIA. But absolutely, this is about a business putting out investments and bets across a number of different areas and platforms.
I also want to know whether his jacket was sparkly or whether it was just alligator skin. I'm looking at it, and this is obviously one of the most important signals for the company, so I'm deeply analyzing Tom. But you mentioned it. Oh, there we go. Actually, maybe it is sparkly. I'm not quite certain on that. Okay, let me talk about more important things, Tom. You can give me your take on his jacket. But the company was focused on, as you say, some of these software and chips that are specifically made for vehicles and for robotics. But at NVIDIA's core, it is these hyperscalers trying to buy their specific AI chips. And that's the kind of growth that the market wants to see. Why not concentrate on that? Why broaden the gate, as it were?
I guess one argument NVIDIA could make is they already have, close to 90% of the market share of AI accelerators. Yes, AMD and others, the hyperscalers, their clients included, are trying to close that gap. But for most analysts, that is still a longer-term proposition in terms of narrowing the advantage that NVIDIA has. So I guess from the CEO's perspective, as he stands there in that glittery, reflective jacket that would look maybe better on Manus Cranny, he's thinking about the future and embedding in other sectors. So yes, the autonomous driving proposition with Toyota is further down the line, Danny. Absolutely. You know, we've seen the challenges around getting autonomous vehicles onto our roads. You see them in Vegas, you see them in San Francisco, but broadly, you're still a long way from mass adoption. But that is a future play for Jensen Huang. And again, the robotics piece of this, he flagged numbers including 1.5 billion autonomous vehicles in the future, 1 billion humanoid robots, 10 million autonomous factories. That is the future that he is trying to position the company for.
Some big numbers. Tom, thank you very much. Bloomberg's Tom McKenzie. Coming up, we're going to catch up with Katrina Dudley of Franklin Templeton with opportunities in mid and small caps. DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the...
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manish Cranny. Let's set your agenda.
The great unveiling. NVIDIA aims to expand its dominance in robotics and autos after closing at yet another record high. Mighty intentions. Washington hits Beijing hard, blacklisting multiple firms across industries from tech to oil. And Mark Carney throws his hat in the race to succeed Canadian Prime Minister Justin Trudeau. Danny, good morning. 25 hours ago, we had a very different story to deal with on tariffs.
It was the whipsaw of Trump policy, but you can see the impact of that. Even Trump denying that Washington Post story that we would see tariffs across the board, yes, but only for specific industries. Trump refuted that, but still the euro is stronger today. It was yesterday. We're little changed on your yields, your 10-year yield at 4.6%. We get an auction today, $39 billion. 2 is 10s. That is the steepest since May of 2022. Equity markets, those are also a little bit weaker a little bit stronger this morning to unchanged after a good day yesterday. NVIDIA leading the charge, another record high. S&P 500 futures up 0.1%. Katrina Dudley has also been looking at this equity market, looking ahead to 2025, not looking ahead, we are in 2025, saying that we see opportunities in mid caps and small caps as earning growth expectations have broadened out, meaning the average stock is likely to outperform in 2025. The biggest risks are higher 10-year yields and earnings disappointments. Katrina, I'm pleased to say, joins us now, Senior Investment Strategist at Franklin Templeton. Katrina, so wonderful to see you. Happy New Year. I think we can still say that. We have seen, I know you see mid and small caps outperforming, but we've still seen so far this year tech being the thing that outperforms and general weakness in this equity market. What to you says that this is a trend that's just been bent and not broken?
So first of all, we are looking at earnings growth because that is the driver of all markets, is earnings growth. And the reason that we're positive on mid caps and small caps is that we see this earnings growth broadening out. And that broadening out of the earnings growth means that tech is going to continue to perform. They are actually going to be one of the highest growth sectors on a 2-year forward EPS basis, but we see all the other sectors are joining the party. I think the lowest forward growth rate is in the consumer staples sector, as you would expect, and that's a 14% growth rate over the next 2 years, compared with tech, which is going to grow over 40% over 2 years. So that's the breadth that we're talking about, that everyone is participating here in terms of growth.
Well, one thing that we saw yesterday, and we've just had a breaking news headline this morning, Michelle Bowman is the top candidate to replace Michael Barr. Banks had a blistering day yesterday. So when you see this kind of shift potentially to a more deregulatory framework within banking, the broad church of deregulation, that breadth that you want to go for, what portion does finance and banking play in the breadth grab?
I think financials are probably like on the bottom end of our earnings growth expectation as we were heading into the 2025 and looking at the forward rates. When you look at a deregulatory market, and I look at the costs that these banks and financial companies have had to bear in order to meet the regulatory burdens, I think that we're probably a little too conservative on our growth rates. So the financials are likely to promote themselves in terms of that stack of earnings. I think that there will be some more opportunities. It just reinforces that message. The second thing is that financials are not part of the Magnificent Seven. Nope. So going back to that average stock, you have a lot of average financials that will be able to perform in 2025 and 2026. They've got a good base in terms of growing earnings, and deregulation, lower costs as a result of that, is going to kind of supercharge those earnings.
And that's also part of the Trump animal spirits, as it were. But yesterday we got a taste of the other side of that coin, and that is policy pronouncements being done on Truth Social this time around, reports from the press being reputed, and this kind of piecemeal of policy as we try to figure out what the greater puzzle looks like. But amid all of that, amid the currency volatility and bond volatility, stocks were still higher yesterday. Is that a model for what this year is going to look like?
I think the resilience of the U.S. market has been surprising over 2024. And you look at some of the bad news that we digested over the course of the year, and the market still rallied significantly. So that's the positive side of all of this. The downside is that valuation. And a lot of people are saying, well, what do these headlines mean, given we're going into the year with a very hefty, high levels of valuation versus history? But valuation has never been a reason just to sell the market. If I look at those forward earnings growth numbers, they support a stronger valuation and higher valuation levels. We've got deregulation. That's another area which supports multiples. And finally, if we just look at those animal spirits, the network effect, everything else that's happening, we're positive. So I think that, yes, you may not have the kind of whipsaw, high rates of return that we've seen in the last few years, but I still think 2025 and even going into 2026, we've got room for the market to continue to move upwards.
So that's a nice bullish sort of foundation for the year. The one debate that has come to the fore is, and Mike Wilson, we chatted about this yesterday, this negative correlation between bond yields and equities. Mads Peterson, I think, just sort of slammed the door closed. He said, stop panicking about 5%. We traveled from 2% to 5%. You're really only going to get spooked in these equity markets if you travel to something like 5.5%. Then you're talking about a growth slowdown. Where's the inflection point for you in your bullish call in regards to that narrative from the bond market, Katrina?
I would love to be able to put a point estimate to say this is the tipping point, that if the bond yields go over,
you can have a bandwidth rather than a tipping
exactly.
point.
So what the reason we're so focused on that is it's the impact on the federal budget and where does that go? And so that's what we're looking. Companies, yes, they're leveraged, but they've got long debt stacks, so I don't really think it's going to come through in the earnings picture if you see higher rates. So it's really coming in at the government level. And when do those federal deficits start to matter? And offsetting that, and we have to remember we've got a lot of good things going on. Not only are we talking about deregulation in financial markets, we're actually talking about efficiency improvements in our federal government. Now, federal government spending is not the biggest aspect, but that mantra and that way of thinking can actually offset some of these other pressures that we're going to see on the federal budget going
So
forward.
do you think that having Elon Musk and Vivek Ramaswamy come in is enough to kind of offset what's expected to be extension of Trump tax cuts, for example, that in and of itself means a growing deficit?
So in terms of the Trump tax cuts, he's already done most of the heavy lifting. He likes round numbers, and so I don't think you're likely to see a significant decline. He could probably cut rates, a few points, and we'll still be able to kind of beat that victory drum that says I cut rates. I think the other aspect that we're looking at is for more detail and granularity as it relates to his trade policy. But if you take a look, from 2016 to 2000, when he was the former president, we did have a tariff regime that was implemented, and it was not negative for markets. And so I do question whether some of these tariffs, particularly as it relates to the tariffs on China, are going to be as inflationary as we fear, because China has gone at 2017, it was around 19% of our imports. It's now down to 10. So it's really lessened the impact and how those tariffs are going to impact us.
It's definitely structurally a different world, although the tariffs pay for about, what, $2.7 trillion worth of the tax cuts. So I think it's going to be about that balancing act in terms of how it's presented. And then we begin to understand, perhaps, the longevity of these tariffs. Katrina, thank you very much. A nice bullish foundation for the start of the year for Katrina Dudley of Franklin Templeton. Coming up with Danny and I, U.S. tensions escalate as Washington's blacklist for Chinese firms, it grows. More on the story. That's next on Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
I intend to resign as party leader, as prime minister, after the party selects its next leader through a robust, nationwide, competitive process. Last night, I asked the president of the Liberal Party to begin that process.
Well, that race has begun with the former governor of the Bank of England, Bank of Canada, excuse me, and the Bank of England, Mark Carney, saying he's considering running to succeed the Canadian Prime Minister, Justin Trudeau. For more, let's bring in our Daybreak News editor, Mark Perrier, on the story. Mark, Mr. Carney has banking pedigree, ex-Goldman Sachs, global banker. He's never run for political office. I'm curious, how do you think Canadians will look at him given the current climate with the Liberals so far behind? Well, this is all going to be very interesting. Carney, obviously well-known on Bay Street, well-known to Wall Street, well-known in financial circles, but can he appeal to a wider Canadian voter audience? That will be the question, and he'll have very little time to do so. If he is selected as the party leader, becoming Canadian Prime Minister, there's very little time to prepare for the Canadian general election.
And it's not just domestic policy, it's foreign policy too, with Trump coming into the White House. Mark, what does all that mean for who the other potential contenders are, and just when we could expect a general election?
The general election will come by October, so Parliament will come back on March 24th, and they'll have to select a leader, hence a new prime minister, by then, and then go straight into election season. Obviously, with Trump coming in, looming tariffs, this is all going to play very greatly into the equation, not only fighting inflation in Canada. It's a big issue, obviously, south of the border, but you have a lot of political tensions as well, potential political tensions with the U.S. that will need to be worked on.
Yep, something the entire world is dealing with at this moment. Mark, so wonderful to have you on, Bloomberg's Mark Perrier. And just a reminder to our viewers that Mark Carney is the chair of Bloomberg's board of directors. Now, over in Washington, the Pentagon has added to their blacklist some of China's best-known companies, including Tencent and CATL, a major supplier of Tesla batteries. Shares of Tencent closed lower by 7 1/3% in the Hong Kong trade, and over a third, and over the company's inclusion Monday on a U.S. list for their purported ties to China's military.
Well, Tencent says in response that it's neither a Chinese military company nor a contributor to the Chinese defense and industrial base. And although the sanctions have no impact on their business, they will nonetheless work with the Department of Defense to address any misunderstanding. Quite a scalable misunderstanding to be on this list. Bloomberg senior editor for tech and strategy industries, Mike Shepard, joins us. Mike, Tencent pushing back. What does this blacklist really mean for Tencent and CATL? Is it a message to the world about doing business with them? The New York Times has it done as a red letter kind of moment for Tencent. What's the impact?
It certainly is a mark on the companies, unlike the Commerce Department's entity list or listings, for example, by the Treasury Department under separate sanctions program. This listing does not carry any specific penalties, but it does have the effect of discouraging companies here in the U.S. from working with anybody who is on that list, because it suggests a certain elevated amount of risk, as you could imagine. Now, in the past, companies have been able to appeal this designation, most notably Xiaomi, which said, hey, wait a minute, we do not have any sort of connection to or control under China's military. No fair, this is wrong, and they have been able to appeal through the Pentagon or even through the courts in the past. So this is something that will unfold. Now, keep in mind that if they are hoping to get maybe a more favorable hearing under President-elect Donald Trump once he takes office, keep in mind that this designation list from the Pentagon was actually ordained by then President Donald Trump in 2020. And the idea was to put a spotlight on companies from China that are controlled by the Chinese military, or at least have a connection to China's military in an economic sense. So it's not like they're going to get perhaps a more favorable view once the new administration comes in. And this is a big deal, as we noted, because these companies, CATL, which has also disputed the allegations, is not only a major battery supplier to Tesla, it's also to a number of other automakers. And it too has come into the crosshairs of policymakers here in Washington who are concerned that CATL somehow poses a security risk to the U.S. as well.
Yeah, but of course, if it's supplying Tesla, it's supplying the company of the first buddy of the United States. I mean, Shep, this does bring back where we started this week, and that was the deal for U.S. Steel and Nippon Steel officially being struck down by Biden under what has been said are national security concerns, something that the Japanese have even tried to push back on, that the companies are suing over. Anthony Blinken is in Japan for his last trip as secretary. Is there some sort of damage control going on? Is there any hope that this deal can survive, Shep?
Well, it is a difficult hurdle to clear in getting this deal through. And the Japanese certainly are trying to make their appeals, and the companies, as you noted, are suing, hoping to get the matter overturned in court. But again, the administration is about to change, and the incoming president has made clear that he too would block this transaction. So it's not like we are going to get an immediate change in the weather here in Washington as far as Nippon Steel's interest in U.S. steel. Now, for Secretary Blinken, as he is making this visit, which was previously scheduled, this was a conversation that was certainly overshadowed by the U.S. against, one of its closest allies, invoking national security concerns to reject a deal by one of its, its own iconic and signature companies, Nippon Steel, attempting to make an investment here in the U.S. So it is certainly awkward. And Tony Blinken definitely had to face some tough questions, including from the Prime Minister, Shigeru Ishiba, who before their meeting indicated that he really wanted some explanation. So this is going to be a lasting issue between the two allies. It won't be insurmountable, but it is the kind of thing that will linger in conversations. The U.S. has tried to make clear that they welcome foreign investment, especially from Japan. It's just that this was too much of a line for them to be able to cross.
Yeah, well, in the very typical Japanese understated style, the foreign minister said it was an extremely regrettable that the decision was made to prohibit the takeover due to national security concerns. Mike, thank you very much. Mike Shepard there on the latest political stories. NVIDIA, we're tracking another record high yesterday. The rally extends through this morning, up 1.6%. The CEO, Jensen Huang, took the stage at the CES trade show in Las Vegas to announce new chips, software services aimed at keeping the AI darling at the top spot.
We used GeForce to enable artificial intelligence, and now artificial intelligence is revolutionizing GeForce. Everyone, today we're announcing our next generation, the RTX Blackwell family.
I want one of the jackets. I know Danny's got one. She's on review for the moment now for me. Let's get to Tom McKenzie. He is tracking this story. Tom, apart from the jacket, we'll talk more about that in a moment. I mean, this is about rolling the dice on the next big evolution in our lives. Robotics, automation in our cars, and this size of this market, the robotics market, is going to be worth $38 billion. What are they doing at NVIDIA that puts them in that leveraged position?
Yeah, you heard from the CEO, Jensen Huang, nodding to the past, but also nodding to the future, to your point. The past being that GeForce chip. Now, it's been updated. It's been underpinned now by their AI technology, the Blackwell technology. And this is a gaming chip, and it's a reminder that gaming is still a significant driver of revenues. That's where the business started. It's now about $10 billion in terms of revenues versus, what, about $100 billion for data centers? So dwarfed by data centers, but still a significant piece of that. And they obviously want to continue to build out the gaming space as well. It's a reminder of their history there. But the future is very much, as you say, at least from the perspective of Jensen Huang, within physical AI. And he described that as a multi-trillion-dollar opportunity. He's talking about autonomous vehicles. He's talking about robots, humanoid robots. He's talking about embedding AI into the physical world around that and having NVIDIA being at the beating heart of that proposition. The challenge, at least according to the analysts at Bank of America, will be ensuring that NVIDIA's software and hardware is going to be cheap enough, effective enough, and pervasive enough to make that a real business proposition, because putting a dollar number on data center sales of GPUs, AI accelerators into data centers is one thing, pretty easy to do, particularly when you have companies like Microsoft pledging to spend $80 billion on data centers. Much more difficult when you're talking about the future prospects of humanoid robots.
Elsewhere in tech, Tom, we have to talk about the remake of Meta in Trump's image, if you will. Already we knew that Sir Nick Clegg was stepping down from the head of global affairs and naming instead a close Republican ally. Yesterday we learned that Dana White of the UFC, who is a close Trump supporter, would also be nominated to the director of its boards. We've had Zuckerberg trying to appeal to Trump. What does this remake say about this moment, not just for Meta, but for tech as a whole, as Trump takes the White House?
Well, look, Danny, as ever, you hit the nail on the head. This wasn't on the top of the press release, of course, from Meta, but this is what this screams, doesn't it? This is a Meta that's being reshaped to align with the incoming Trump administration, given, as you say, the head of international communications, Nick Clegg, the former Deputy Prime Minister of the UK, stepping down, being replaced by someone who, of course, leaned and supported Republican, and now Dana White, of course, a very close and long-time supporter of President Trump. He was there campaigning during that election, of course, the CEO of UFC, now on the board. 3 new members, also a member of the family, at least the CEO of the family that has stakes in companies like Ferrari and Juventus. But that is the key takeaway, I think, is this is a company, this is Mark Zuckerberg, who is ensuring that the team at the top, the board, is more closely aligned with that incoming Trump administration. He dined with him in Mar-a-Lago, don't forget, a few weeks ago as well.
Yeah, as a lot of tech executives have done, make the pilgrimage down to Mar-a-Lago. Tom, thanks as always, Bloomberg's Tom McKenzie. By the way, don't miss our interview with the NVIDIA CEO, what Jim Bianco called the most important man for this equity market. Jensen Huang speaks to Bloomberg at 11:30 a.m. Eastern Time this morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Let's get you set up for your trading day on this Tuesday. Richmond Fed President Tom Barkin will be speaking, delivering remarks at 8 a.m. Eastern. Then some data for you. JOLTS job openings and ISM service numbers come out at 10 a.m. And the big one, our interview with NVIDIA CEO Jensen Huang at 11:30 a.m. I love Jim Bianco putting out on X Manus that he's the most important man for this equity market. Forget Jay Powell. It's all about Jensen Huang.
Indeed, the godfather of AI, as Wedbush Securities, Dan Ives calls them. Some stocks, of course, there's NVIDIA, rallying through to a record high. It's all about robotics, that business going to be worth globally $38 billion. New products coming through. Let's see what the interview yields. Micron Technology, the shares jump. NVIDIA named the firm as the supplier of, you got it, the new GPUs. And then Uber says it's teaming up with NVIDIA, you got it, in order to accelerate the development of autonomous driving technology. So it is just this booming tech story, Danny.
Meanwhile, you have the dollar continuing to weaken despite Trump refuting that Washington Post story. It perhaps shows how one-sided this market was, with CPI moving higher in Europe.
To succeed in Wall Street, what skills do you need? Do you need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time? What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Market, I think, is more focused on the near-term effects of tariffs.
The markets will cheer a narrower approach to tariffs.
Markets have been sort of underestimating how much the Trump administration likes tariffs as more than deal-making.
I don't think any of us know. I'm not even sure the administration knows what the final set of tariffs are going to look like.
We're still in this waiting game. Things are proposals right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday on a 2-day winning streak on the S&P 500, leaving behind a 5-day slide, the longest losing streak going all the way back to April of last year. Equity futures on the S&P 500 up by about 0.1%. On the Nasdaq 100 up by 0.11. Going into a big day for economic data. A little bit later on today we'll get the jobs openings report. Then on to tomorrow, ADP and jobless claims and payrolls just around the corner. In our survey, the median estimate is about 163. The single name we have to start the program this morning with, though, is Tencent. Tencent is getting absolutely hammered in today's session. We are negative by more than 7%, Lisa. A blacklisting from the United States of America.
Yeah, designating Tencent as a military company. This adds to the list, the growing list of other companies. They also had a battery manufacturer that is a component of Tesla that they added to the list. Question here of what this is, especially with the tit-for-tat developing with China reciprocating with a number of companies saying that the likes of some of the big U.S. companies, including NVIDIA, also are potentially at risk for them.
These kind of designations, and to be on this list, which actually stems from a list that came out during the Trump 1.0 administration, basically means these companies cannot sell into the U.S. military. But then there's the reputational risk, if you're a U.S. investor, on why you'd want to get involved. And the concern is about these specific companies, what they have to report back to the CCP. My big question is why, in the final days of the Biden administration, are they going after these top two companies?
The sitting president, Joe Biden, by the way, is determined to remind everyone he is still the sitting president of the United States because they have been incredibly busy over the last few weeks.
Incredibly busy when it comes to things like oil and gas leases across the United States. We are still waiting, and it should be in the next few days in terms of more sanctions on Russian oil and gas. There's going to be a number of measures that Biden is going to take on the final days out of office.
As we close out his final days, we're anticipating the first few days of the Donald Trump presidency, which most people assume started in early November. And yesterday was that first classic day of the Trump era. That first classic day of getting a report from the Washington Post. We sat here, we read it, and we said, wait until you hear from the incoming president. What did the incoming president do? Batted it away.
Basically, totally inaccurate. I'm not watering anything down. They're not going to be narrow tariffs. What I thought was interesting was the moves of the markets. We were talking yesterday about how maybe you can learn more about what the market does than maybe what the headlines are at this point. The fact that a lot of those moves stuck, that dollar weakness stuck, and that the move was significant in terms of dollar weakness, euro strength, Mexican peso strength. And yes, it were traced after Donald Trump's rebuttal of the Washington Post report, but not completely, shows how offsides this market has gotten with dollar exceptionalism, U.S. exceptionalism, and how much has to happen to really undo that.
When it comes to the Trump world and how they operate, and there's different factions, remember Terry Haynes also talks about a cabinet of rivals. You are going to see the sausage making in real time, more than I think the market has been used to over the course of the last 4 years.
Whipsawed from one report to the next. The euro, by the way, to Lisa's point, stronger for a third consecutive session. Euro dollar north of 104 again, 104.23 and positive on the day by about a third of 1%. Coming up this hour, we'll catch up with Julian Emmanuel of Evercore, calling 2025 an inflection year for AI. Eric Nelson of Wells Fargo as Canada searches for a new prime minister. And Torsten Slock of Apollo seeing upside risk to inflation. We begin this hour with stocks looking for a third straight day of gains. NVIDIA unveiling new products and renewing optimism over AI demand. Julian Emmanuel of Evercore writing, with consumers enthusiastic on AI adoption, yet sentiment in corporate America relatively muted, 2025 is the critical AI adoption inflection year. Julian joins us now for more. Julian, good morning.
Good morning.
And a happy new year. It's good to see you, sir. Let's get that out of my system.
Statute of limitations there.
We're getting close to
7
mine.
days. Okay.
We're getting close to mine. Friday. But before we get there, Happy New Year, sir. 6,800 base case for you on the S&P 500. Middle of this year?
No, that's our year end.
Year end.
Yeah.
Okay. We've had a couple of guests come on this program say that the man of the year is potentially not going to be Donald Trump. It's not going to be Jay Powell. It could well be Jensen Huang. Do you agree with that?
He made a pretty good case last night for that being the case. Look, go back to the start of this bull market, October of 2022. AI has been literally the one constant theme. You know, a month later, ChatGPT was unveiled to the world, and you've had this incredible enthusiasm building. We all use it in our daily lives. And what we've seen is that corporate America has been slow and cautious in rolling it out. The bigger companies have adopted it more quickly. And the work we did a year and a half ago basically pointed, looking at past adoption curves, as 2025 being the big year. And basically what you heard last night at CES is that there are lots of reasons in terms of how the technology has evolved to believe this is going to be the inflection.
You alluded to it. The big tech firms certainly haven't been slow and steady about investing in all of this. We've seen the CapEx ramp up big time in the last couple of years. Adoption, I think, is the key point here. How close are we to us sitting here around a table and me reading out headline after headline of job cuts after job cuts because these companies are adopting this technology and they no longer need the staff?
Well, I think that that's been part of why it's been, cautious and steady, but not explosive yet, is because there is a sensitivity around this idea of job cuts. And frankly, when you think about it, the economy, as strong as it is in the U.S., is actually going to set the backdrop for that transition to occur more seamlessly than it might otherwise be if we were, growing sort of, call it sub 1%.
If this adoption does start to happen, are the big tech players like NVIDIA the ones that are going to keep benefiting the most in the stock market? Or are you going to see it broaden out, which we haven't seen so far this year?
Well, in general, you have the biggest names in these kinds of technological revolutions. It's not a winner-take-all, but it's a winner-take-most. And that's what we've seen. And I think part of what the misunderstanding was a year ago or a year and a half ago, when we all thought, well, there are fewer barriers to entry to using AI simply because you don't need desktop, you don't need the lay cable like you did in the internet revolution. Well, you do need people to deploy, you do need people to supervise and understand how the data gets worked. And that leads into the bigger names with more capital and more budget being able to, really dominate the playing field.
When you start to talk about big numbers, John, you were mentioning about how much capital some of these big tech companies are putting into it. Last week, Microsoft announced another $80 billion into their AI data center build-out. You talk about this. Most of that, who would that benefit? NVIDIA. And it raises this question, as we've seen this year start out the same way that we saw last year really end up, which is big tech continuing to dominate everything and almost masking weakness and concern that you're seeing under the hood and other potential names. Is that going to be the contour of 2025 in terms of the stock performance?
Well, we actually think that you are going to get the broadening this year. And if you think about it, right, the deregulation backdrop that we're about to have in the incoming administration is profound. But if you think about the capital market cycle, what may be different this time is in thinking about the rest of the world, we think there's going to be more activity in mid-cap names simply because those kind of companies don't have as much exposure per se to Europe and to China. And so the regulators there won't be as much of an issue to getting deals done, down the market cap.
Why haven't we seen more of that, though, now? Already pricing in. You think we've seen enough?
Oh, we've seen a lot of it priced in. I mean, look at the rip in the regional banks, if nothing else. There's a lot of that excitement priced in, and it's just a question of time, in our view, before the deals start to happen, because it does make sense.
Okay, so if you're focused on, Jensen Huang being the most important person of 2025, can we talk about the second most important potentially in terms of what this market cares about, and that's the incoming president? What did you make of yesterday, and what does it tell you about how the market what they should be paying attention to in terms of the whipsaw we saw between headlines and how they reacted?
I think we can all be forgiven for not believing or thinking that this new year is 2025, not 2018. 2018 was really the year where all of the policy initiatives got unspooled, and literally you would have, we would write our research reports Friday afternoon, then you'd hear a tweet and we'd have to rip it up all again for Sunday publication. I think we all need to get used to that, but the cadence of the market being 3 steps forward and 2 steps back does not mean that we're not still in this bull market. It just means it's more volatile, which it should be with valuations where they are.
I remember a lunch we had together in late 2017. You won't mind me sharing this. And you talked about the low volatility trades and the risk of them exploding going into 2018. It was followed by Volmageddon. Do you think this is a 2017 setup or an 18 setup? How do you think about what kind of year we're going into?
Our base case is for volatility, episodic volatility. Think about it, right? We saw that number, 2.5% core PCE, hit the screen on December 18th, and then we had a massive volatility spike. We go back to August, there was a couple of memes about yen carry trade unwind, and the VIX went to 65. But we're still in a bull market. But that's the world we're living in.
This takes us to bond yields. Are we at the mercy of the bond market still? in this equity market?
I wouldn't say at the mercy, but it is much more important than it has been in the past, because it's going to be part of what guides the ability of the incoming Trump administration to achieve what it's trying to do. You know, if yields start moving towards 5%, the feedback might be, well, some of the policies are perhaps more inflationary, or yes, we've got to figure out what to do with the debt ceiling. But for equity investors at these valuations, you have to be sensitive to bond yields.
Which raises the question about whether the most important economic data point of today is going to be JOLTS at 10 a.m. Eastern, or whether at 1 p.m. Eastern, when you get the 10-year auction, that's going to be the most important economic data point at a time where you're seeing a disproportionate increase in longer-term yields versus short-term ones. That 2s10s yield curve is now the steepest going back to 2022. Is this a good sign or a bad sign?
Well, so this speaks again to how data is now different in this post-pandemic environment. If you look at the last 50 years, going from inverted to steeper usually means the recession is right around the corner. Well, it doesn't mean that at this point. The economy remains very solid. From our point of view, the recession risk in the coming year is low. The credit markets are telling you that. But it is something that we will have to continue watching, because simply the absolute price, yield price of the 10-year, look, over this cycle, when you've gotten towards 5%, that's when all asset markets have run into problems. We think that could be a possibility at some point this year.
Julian, it's good to see you. Happy New Year.
Thank you.
Thanks for being with us. Check out the bond market this morning. The 10-year at the moment is up by a single basis point, 464. Go to the very long end of the curve. Let's talk about 30s. The 30-year in America, yields we haven't seen going back to 2023. On a 30-year, we saw that headline yesterday here stateside. Go to the UK. Levels we haven't seen since 1998. Lisa, what is behind these moves in the bond market? Because the why, the what, is more important than the number sometimes.
In the United States, there's a twofold question here about how sticky inflation is and what the deficit is going to look like in the issuance of debt and how much that's going to factor in. In the UK, you add to this sort of stagflationary environment that you see with inflation data all across Europe performing to the upside, surprising to the upside. That is a downside surprise, a negative surprise compared to what people want to see. It just goes to the heart of the existential angst of the moment, which is, are we underappreciating just how sticky inflation is and how pernicious that could potentially be accompanied by slower growth?
Look out for Torsten Slok of Apollo on this very conversation later this hour. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Mark Carney, the former governor of the Bank of Canada and Bank of England, is considering running for Prime Minister of Canada to succeed Justin Trudeau. Carney has received support from Liberal lawmakers and supporters who want positive change and a winning economic plan. Carney holds a series of business and philanthropic positions, including serving as the chair of Bloomberg Inc. Treasury Secretary Janet Yellen spoke with China's Vice Premier He Lifeng a week after the U.S. said the Chinese state-sponsored hackers had breached about 100 Treasury Department computers. Yellen expressed concerns about malicious cyber activity. The Treasury Secretary also warned of consequences for Chinese companies that support Russia's war in Ukraine, as well as Chinese industrial overcapacity that she says is harming U.S. business. McDonald's is no longer setting aspirational representational goals. It's a revamp of its approach to diversity, equity, and inclusion policy. The company is retiring its DEI pledge in its supply chain and renaming its diversity team as a global inclusion team. McDonald's cited the evolving landscape around DEI in the U.S. as a factor in its decision. And that's your brief, John.
Danny, thank you. Well, I could talk about this topic all day. I think it's one of the major shifts taking place in corporate America at the moment. I think we have to acknowledge up front there are some legal issues, potential legal issues that corporate America has to navigate here. But I'm pretty cynical about all of this. This was never about values. It was always about selling product and selling services. And I think, as you've seen over the last decade, and we've talked about this repeatedly, these companies wanted to sell to a progressive consumer and insulate themselves from the regulatory impulse of the left, which is why they took on all of these values to begin with. Now we're seeing a major shift. I think they've got to worry about a conservative consumer. Think Budweiser, think Target, other examples. And I think they now need to be concerned about something they haven't thought about for the best part of a couple of decades, which is the regulatory impulse of the right, the Republicans.
Well, that's where I was going to go. How much of this is catering to consumer preferences or consumer pushback versus the political shifting winds, and how much are those two things intertwined? And that's sort of a question as we see an increasing number of companies really shift away from DEI.
Tech probably the greater focus here on the regulatory front, and we'll talk about Meta a little bit later. Up next on the program, tariff confusion.
There's a question of what could actually be implemented with executive authority versus congressional authority. I think it's very plausible that a lot of these tariffs are going to go on, including some very aggressive tariffs on China, but the implementation could kind of ramp up over time.
That conversation up next, live from New York City this morning. Good morning.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Live from New York City, welcome to the program. Equity Futures right here with a lift again, up 0.1% on the S&P in the bond market. Check out bond yields, up again, just by a single basis point, 464, but Lisa will tell you there's an important auction a little bit later. She'll tell you more about that later on, 464.22. Under surveillance this morning, tariff confusion.
The problem is that there are tariff principles that the president-elect has put out there in terms of wanting to make sure that the U.S. and its trade partners are more equal footing from a tariff perspective. But then there's a question of what could actually be implemented with executive authority versus congressional authority. I think it's very plausible that a lot of these tariffs are going to go on, including some very aggressive tariffs on China. But the implementation could kind of ramp up over time.
So here's the latest this morning. Markets absolutely whipsawed by conflicting reports in the last 24 hours. The Washington Post suggesting Trump's aides are looking into tariffs that would only apply to critical imports. The president-elect Donald Trump quickly pushing back, saying the story, quote, incorrectly states that my tariff policy will be pared back. That is wrong. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, I guess the first question for you, what is actually going on?
Yeah, good morning, John. So President-elect Trump quick to dispute that Washington Post reporting. Whether or not that does result in universal tariffs once he takes office remains to be seen, but it's clear that he's pushing for universal applications. I took a look at his Truth Social post for this week alone, and it's only Tuesday, and a quarter of his posts mention the word tariff, whether he's talking about Canada, the Nippon steel deal, or perhaps where we're watching most closely here in Washington, using tariffs as a potential revenue raiser for his proposed reconciliation package. That could be in a bid to court Republicans who have have time and time again told us on Capitol Hill that they're concerned about pay-fors for a potential Trump agenda and expected tax cuts. Of course, though, John, in none of these posts are concerns about any potential inflationary or retaliatory impacts, which is actually why I'm watching closely this month's consumer sentiment readings from the University of Michigan, which is a little more sensitive to politics, and how Americans are starting to internalize these potential economic impacts as we get closer and then ultimately start the Trump presidency this month.
Well, we're seeing the sausage making play out in real time on a number of issues with the incoming Trump administration. It's clear he wants optionality. Yesterday, when Trump was talking to Hugh Hewitt, he talked about the fact that maybe he would be even open to 2 reconciliation bills. And he's potentially going to be meeting with Republican senators. What's the big debate right now that's still brewing between the House and the Senate over how they pass his agenda?
Yeah, Anne-Marie, I was actually talking to one Republican strategist yesterday who's advocating for that 2-bill approach to separate out the priorities when it comes to immigration and energy and then save the tax overhaul, that more prickly fight for later down the road so that way Republicans could notch some early wins. Now, we know that the Senate Majority Leader John Thune is more inclined to that 2-bill approach because when you look at, as you refer to, the sausage making getting done, it's difficult to see how everything could be folded into one bill when there is so much disagreement. So instead, maybe separate out some of those priorities where we see a little bit more widespread support. But we should, this time next week, we should have a clearer picture of that because, as you mentioned, we are expecting Trump to meet with Senate Republicans. But then this weekend, he's invited a whole different cohort of House Republicans to Mar-a-Lago that all have different sort of fights in this reconciliation package, whether that's the House Freedom Caucus or members that represent districts impacted by the SALT deduction down to Mar-a-Lago so that they can start to hash out their differences.
I guess the question then comes to who wins? Who wins in this fight when it comes to how they decide they're going to implement his agenda?
Right. I think at the end of the day, President-elect Trump just wants an early win. And ultimately, he's going to go with the path that will get him that. As you mentioned, he signaled that he is opening the door to a potential 2-path track if that's ultimately what it takes to get his agenda accomplished. We know that he wants to come out of the gate with some early wins to notch and then ultimately put forward some of perhaps these other policies that we are talking about when it comes to tariffs. But it's clear that he wants some of these tangible deliverables on the table first.
Yesterday, Fed Vice Chair for Supervision Michael Barr said that he was going to step down effective February 28th from his position, really overseeing a lot of the bank capital rules. Is this an early win for Donald Trump?
Right. So Michael Barr has long been a target, particularly of Senate Republicans. We know that incoming Senate Banking Chair Tim Scott yesterday put out a statement absolutely blasting him, blaming him for the 2023 regional bank crisis and also the capital rule requirements under the Basel III endgame proposals. And it was clear that he's been a target since he was appointed by President Biden in 2022. And Lisa, I can tell you, I was in the room when Jerome Powell said that Trump did not have the authority ultimately to fire a Fed governor. And you could hear a pin drop in that room. It was so resounding. But it appears that Barr wasn't up to, it appears Barr was looking to avoid that potential fight. But important to note, he stepped down as vice chair. That, of course, limits the options to replace him, particularly as Trump now has to look at the Fed governors to instead fill that role.
Right, which has led some people to talk about Mickey Bowman. The question, and you were tripping over it, whether he wasn't up for a fight or whether he thought the fight might not necessarily be good for the Fed. I actually don't blame you at all because this is actually a real key question for people. Do people think that this undermines the Fed? Or does it actually support it, edify it by allowing one of the current Fed governors to step in? How is it being perceived in Washington?
Right, particularly, and we have been watching closely, even on the campaign trail, how President-elect Trump was dealing with the Fed and this idea of Fed independence after he had previously said that he felt that the executive should actually have a role in these monetary policy decisions. And we had even heard floated this idea of a potential shadow Fed chair as a potential policy that could be implemented under an incoming Trump administration. Ultimately, though, when it comes down to it, Senate Republicans have all applauded this decision as widespread. And you mentioned, of course, Michelle Bowman now being floated to potentially fill that spot. She has long been considered a potential ally when it comes to this Republican nominee appointed during the first Trump administration.
Hey, Tyler, going to catch up. Tyler Kendall down in Washington, D.C. We'll catch up with French Hill of Arkansas later on this morning. The House Finance Committee chair had this to say following that resignation, Lisa. I was pleased to learn that Michael Barr is stepping down. A lot of Republicans share that view.
So in 2023, he was the person who really put forth a series of capital rules that elicited a ton of pushback from the financial industry, saying this would cripple banks or reduce lending. And his stepping down comes ahead of an administration that is absolutely going to wage war on all regulation of banks and try to deregulate the banking sector. It just goes to show that there is a very narrow line about whether there is a sort of a negative issue tied to fighting this president when it comes to Fed independence, or whether it is the appropriate thing. And it is unclear about how it's perceived. It's clear where he weighted on this.
Congressman Hill joining us in about 50 minutes' time. Do not miss that conversation. Who remembers the family photo of the G7 in the south of Italy in the summer? And Anne-Marie was down there and she said, how many of these people are going to be left in 6 months? We'll count. Up next on the program, Eric Nelson of Wells Fargo.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Two-day winning streak on the S&P 500, leaving behind that 5-day losing streak to close out and begin 2025. Equities right now on the S&P 500 up by 0.1%. On the Nasdaq, up by 0.1% also. On the Russell, the small caps doing okay, up by 0.2%. Lots to talk about in the bond market, particularly at the longer end of the curve, and we can start from 30s and work our way in. The 30-year yield is up a single basis point in the US at 4.86, so close to levels we haven't seen since late 23. In the UK, close to levels we haven't seen since the late 1990s. Starting to look a little bit painful in British markets.
Especially when it's not accompanied by the growth that a lot of people are expecting in the United States. And it really produces this quagmire that, frankly, both the Bank of England and the ECB are facing, which is inflation is proving to be sticky, even at a time where they need to generate some growth and, frankly, might limit how much they can cut rates.
Sterling doing better this morning. Cable, the pound, doing better against the US dollar. In the last 24 hours, everything was doing better against the US dollar. Really, that was initiated by that report coming out of the Washington Post, suggesting that the incoming aides of President-elect Donald Trump were thinking about or proposing ideas that would water down a universal tariff. President-elect Donald Trump pushing back pretty quickly. But those moves hold, Lisa, and you made this point, euro-dollar at 104, which I think speaks to a lot of things, and one of them is positioning and how loaded the boat was to the one side going into that release.
I think that's the more important takeaway, because as we were talking about yesterday, we're going to get a lot of this whipsaw, a headline that says this and then another tweet that says, or a truth posting that says it's not true. The point here is that there is a lot of hope that we can unlock a little dollar weakness and a little strength elsewhere. You see that also in some of the equity indexes over in Europe, the sort of hope that maybe all the pessimism has been priced in and just how little it will take to get some flows into the region.
Not much needs to go right to trigger a big move in the opposite direction when positioning is so lopsided like it has been building over the last month or so. That's euro-dollar 104.08. Under surveillance this morning, one of our top stories, NVIDIA CEO Jensen Huang unveiling new products during his keynote presentation at the CES trade show in Las Vegas. The lineup includes graphics cards for gaming PCs built on the company's Blackwell chips and software to help companies develop autonomous driving and robotics AI.
My favorite part of this is the future that he put out there of 1 billion robots and 10 million factories that are automated, and just the idea of our humanoid but not quite human future that also includes $1.5 billion of self-driving cars and trucks. The idea of where this application will go and the hope that it will happen soon, with him even name-dropping some specific car companies who soon quickly got a boost in their equity shares. A question here of whether he can come through with this and whether NVIDIA is just showing why NVIDIA will be the biggest winner of this transformation and not that broadening out.
Well, they have the software component, they have the chip component, and now it feels like they're going to be pervasive everywhere. And it goes back to what Julian Emmanuel said at the start of the program, which is basically this is an inflection point this year for AI adoption and how we see it really circulate across consumers and everything consumers use.
And we've got the conversation that matters coming up on Bloomberg TV. Do not miss this. 11:30 Eastern Time on Bloomberg Television. Bloomberg's Ed Ludlow will be sitting down with Jensen Huang live from CES in Las Vegas. Must watch TV a little bit later this morning. Elsewhere, the US blacklisting Tencent and CATL for alleged links to the Chinese military. Both companies pushing back, saying they have no ties with the military. The move threatening to disrupt the global EV market, with Tesla and other major automakers dependent on batteries made by CATL. Tencent came out and said this must be a mistake. We have no relationship whatsoever.
The issue is the fact that if you are a Chinese company, what U.S. officials will tell you is they have an obligation sometimes, if there's a national security concern, the CCP comes to you and says, we need to know about this. They have an obligation then to share that information with the CCP. I will say the incoming Secretary of State, Marco Rubio, talked about CATL in August. The fact that this is he was talking about this could potentially be a vital supplier to the PLA, and he wanted it to be put on this blacklist. I think you're going to see a lot of this. This list designates from Trump 1.0. The question I have is why the Biden administration waited for the last 2 weeks on their way out to decide to put these two names on it.
Yeah, especially after all the hacking news. I mean, let's just talk about how much, hundreds of government officials have been hacked into, people using now text and Signal to try to avoid CCP oversight in the United States. So there's a real question here about whether this is truly a tit for tat with China retaliating, or whether this is something more, where there suddenly is this broader recognition and an increasing decoupling of tech in the United States and in China.
Lisa, I'm glad you brought that up. We talked about yesterday how we all read this very detailed report from the Wall Street Journal over the weekend. The first line of that talks about Chinese hackers gaining the ability to shut down dozens of U.S. ports, power grids, and other infrastructure targets. Jake Sullivan told telecommunication technology executives at a secret meeting in the White House in the fall of 2023. So more than a year ago.
Kind of shocking. You think about the arc of policy coming out of this administration towards China. You have to go back a couple of years and remember that at one point, they were considering taking tariffs off China because of the inflation fight, which is kind of amazing given that everything that's happened reportedly since then over the past few years.
Right, because they were looking at any lever they can pull to try to bring inflation down, because this was the biggest issue Joe Biden had domestically. And one of them was going to be potentially, and this they oohed and ahed, it was a big Treasury versus national security concern debate for months. In the end, Joe Biden said, no, we're going to keep those tariffs on. But you're right, it was something they were looking at doing for months.
Tencent getting hammered off the back of all of this. Meta elsewhere, electing 3 new directors to the board, including Ultimate Fighting Championship CEO Dana White. White has been a vocal supporter of President-elect Donald Trump, speaking at the Republican National Convention and Trump's election night event.
This is just another one of the big tech companies that are adding more conservative members to their boards. This does come after Mark Zuckerberg does have a relationship with Dana White going back, so it's not completely out of the blue. Should note that. At the same time, it kind of speaks to the point you're making earlier, which is companies are adapting and adjusting to this new political regime, and they're doing so at a very quick pace.
They're adapting to the fact that the election showed this is a center-right country at the end of the day. And it's not just Dana White, which when I view him, I just remember Trump being at the RNC talking about the fact that he decided to leave his vacation early to come here personally and introduce Trump. Not Melania Trump, Dana White introduced Trump at the RNC. So when you think of him, you do think of the Trump world. But also Nick Clegg is out. You guys talked about this last week.
Yeah.
Joel Kaplan, deep Republican ties, is now the man that has to deal with policy.
Watch this space. It's not the first, it's not the last. The winds of change. We're going to see a whole lot more of this through 2025 and maybe even beyond. Let's turn to Canada. Prime Minister Justin Trudeau resigning as head of the Liberal Party after more than 9 years in power.
I have always been driven by my love for Canada, and Canadians deserve a real choice in the next election. And it has become obvious to me with the internal battles that I cannot be the one to carry the Liberal standard into the next election.
And given where the polls are right now, 20 points behind the Conservatives, that choice might turn out to be a big change. And there has been a major change. Go back to the G7 photo in the south of Italy 6, 7, 8 months ago. Anne-Marie, you were down there. How much that's changed in the last 6 months, half a year?
We talked about it. I was reporting live from Bari that this was a lame duck lineup of leaders except for one. Giorgia Meloni, who basically greeted everyone. It felt like they were all going there to kiss the ring in southern Italy of this new leader of Europe, this Principess of Europe. Yeah, Emmanuel Macron's there, but he has been dealt a huge blow domestically. She's really the only one left in this list of leaders.
We've seen reports that Governor Carney may be interested in throwing his hat into the ring. Of course, Governor Carney is the chairman of Bloomberg Inc. We should recognize that. I would say this, though, for anyone looking to throw their hat into the ring here, you're 20 points behind the Conservative. Why would you want to get in now? Wouldn't you just wait, have the election, watch them fail, and then jump in?
This sort of goes to the question of how much the U.S. is a template, showing what you should do and what you shouldn't do. And maybe Justin Trudeau is trying to get out early to avoid a Kamala Harris, Biden kind of situation where you get out at the very end, you don't leave as much time to a potential candidate. But you're right. How big of a gap can you possibly close when you do have momentum on such a level on the Conservative side?
Eric Nelson of Wells Fargo joins us now to talk about potential market implications. Eric, welcome to the program. There has been a clear and obvious shift against incumbents and in many cases towards conservative leaders. Eric, what do you think the market consequences of all of that are going to be?
Yeah, John, who would have guessed that Italy would be the bastion of political stability in the G7? That was certainly not expected, but yeah, there's obviously a lot of forces domestically in all these countries, whether it's immigration, inflation, driving that. I think it really depends on the country, right? You look at Germany, I think there's some positive forces and sort of catalysts that could come out of the election in February, right? Potential changes to the debt brake. Germany has been a beleaguered economy for several years now, underperforming most in Europe. So I think there actually could be some positive catalysts there. You look at a place like France, maybe a little bit less so. There's still a lot of consternation, and it could be messy if there's another election this summer. Canada, though, this is all about tariffs, in my opinion. You know, domestic policy in Canada is not really moving the currency markets all that much. Question is, how fast does Poilievre come into power? How fast can he get into these tariff negotiations? Fortunately, though, I'll say, Trudeau, I'd say, sent some positive signals after his visit to Mar-a-Lago at the end of last year. I think Canada, on the whole, can avoid the worst of the tariff sort of issues and implementation, but it's going to be a rough ride for the next few months here.
Eric, I just want to underscore something you said. Essentially, it doesn't matter who comes, who goes, the leadership of any of these countries. What matters is tariffs, in terms of just where the currency is, and that has been the reason behind the loonie strengthening over the past couple of days, as well as the euro. Is that correct?
In the case of Canada, absolutely. Again, I don't see any real material change in domestic economic policy, maybe some slight fiscal tightening from the Conservatives in Canada if they come into power. I think Germany is a different story. Tariffs matter hugely, but so too does domestic policy, right? We know the German economy has lagged for a long time. They need debt brake reform. They need to unlock some of that fiscal spending. I think Merz is the kind of candidate that can deliver that. The question is, does he have the backing, right? Does he have that supermajority in the Bundestag to really deliver that? And that's what we'll have to find out at the end of February.
There's also this sort of question around Europe, which is how do you pair tariffs with the idea that inflation is sticky and might limit how much the ECB can cut rates? How do you sort of juggle those two ideas?
I think tariffs themselves are probably not inflationary to the extent they're going to move the needle on ECB policy. If anything, they're probably demand negative. We know Germany in particular, very manufacturing export dependent. But if you look even pre-tariffs, just the last few weeks, some of these inflation prints we've been getting out of Europe have been a little bit hotter, right? You look at the just this morning, the ECB inflation expectations figures, pretty strong. And German inflation numbers yesterday also on the hot side. So we're coming into this with a little bit of actually fresh momentum in European inflation. That's going to make the ECB's job more difficult. And one reason why we think that sort of front end, short end rates in Europe and Germany have some room to recover here alongside the euro.
Eric, what did you make of the whiplash we saw yesterday with the Washington Post story talking about how this might be a more narrow, targeted approach on critical imports into the United States, and then Donald Trump walking that completely back? When you see that episode, really on one of the first big trading days when people are back from the holidays, what did you learn from that potentially you're going to be looking out for the rest of 2025?
We saw this just time and time again in 2017 and 18. And I think my takeaway is there's some kernel of truth to the story. I think there probably is an initiative being worked on by the likes of Besant, Lutnick on this sort of initiative. I don't know that it's the only initiative, right? There's still the U.S.-China piece, which I think is really its own track for tariffs that wasn't really mentioned as part of this story. I suspect that is something that's being worked on in parallel. There's a lot of Section 232, Section 301. I think it's going to be a multifaceted approach on tariffs this year. I think Trump's denial is not necessarily that surprising, right? You don't want to necessarily signal, hey, actually, all that tough talk I had on the election campaign, it was really just bluster, right? You don't want to send that message. So I think there is a kernel of truth to this. I do think that, our baseline is that we're not going to get 20% tariffs on all countries, on all goods, right? I don't see that happening. I think what it really reveals, and you were talking about this earlier, is positioning, right? You just needed one headline to get a little bit of relief in this dollar strength trade. I think it's going to be a very back and forth year for the dollar. We're still bulls on the dollar, but I realize short term we could see a little bit more consolidation and some dollar weakness the next few weeks.
If we could just build on that kernel of truth and coming back to Canada where John started the conversation, if it was to be critical imports, what would that mean for Canada?
Well, Canada is a big exporter of iron and steel to the U.S., so if this is going to be via Section 232, sort of a national security route for tariffs, yeah, Canada is going to be certainly in the crosshairs. It's not, at the end of the day, energy is really what Canada tends to export to the U.S. primarily, right? So as long as that's not included, Canada is going to avoid the worst of this. There's also some sort of off-ramps, some side letters in the USMCA agreement that actually allow for some delay in tariff implementation between the U.S. and Canada. So that's also sort of working in Canada's favor here and potentially helping to at least delay or at least maybe ideally allay some of the biggest concerns from U.S. putting tariffs on Canada.
Eric, good to see you. Great to catch up. Eric Nelson there of Wells Fargo on the latest and the changing face of the G7 in the past 6 months or so. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Sticking with President-elect Donald Trump, he is looking to keep the special counsel's report against him from becoming public. Trump's lawyers are arguing that the report should not be released, citing Jack Smith's political motivation and desire to undermine the transition. Smith had dropped his case against Trump after the election, citing long-standing DOJ policy against prosecuting sitting presidents. Getty Images and Shutterstock have announced that they will combine in an equals transaction merger. The combined company will have an enterprise value of about $3.7 billion. Once the merger is finished, the company will be named Getty Images Holdings and can continue to trade under the ticker GETY. Shares of both companies, as you can see, are much higher in the pre-market. Home prices in the UK have dropped for the first time in 9 months. Average prices fell 0.2% in December to just over $370,000 US. They had climbed to a record high last summer. The drop in prices is attributed to stuttering economic growth and high mortgage rates, which are expected to continue to pressure the housing market. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next, the Fed's fight against inflation.
I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. All of this is just suggesting that the acceleration story is going to be the bigger issue.
Apollo's Torsten Slok, up next.
About artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Two-day rally on the S&P 500. Can we make it day 3? Equities just about positive on the S&P. Under surveillance this morning, the Fed's fight against inflation.
I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. Added to that the inflation rate is not getting to 2%. There is an argument to be made that it is stalling it around, the high 2s if you measure it by CPI, because we're at the same levels on year-over-year CPI that we were 7 months ago. And all of this is just suggesting that the acceleration story is going to be the bigger issue.
So here's the latest this morning. The US 30-year bond yield climbing to its highest level in more than a year as investors remain concerned over a potential reacceleration of inflation. Torsten Slock of Apollo noted the impact of the Fed cutting 100 basis points, writing the bottom line is that Fed cuts and associated developments in financial markets will boost GDP over the coming quarters by 1 percentage point and boost inflation by 0.5. Torsten joins us now for more. Torsten, good morning.
Morning.
It's good to see you, sir, and a happy new year. You wrote, and I think it's important to recognize, they cut 100 basis points in September, and yields moved 100 basis points in the other direction. What do you think explains that?
Well, that is really unusual. I mean, normally the textbook would say if you cut interest rates, long rates should also be going down. So why is it that when they have cut 100 basis points in September, that we've now seen long rates go up 100 basis points in September? And that's opened up a lot of conversations about, is this because Fed cuts were not warranted? Is that because of fiscal policy? Or is it because of less demand from abroad? There's just a very important quantification debate around why is it long rates are going up. And an important part of that question is that the term premium has gone up 80 basis points, at least according to the New York Fed. So using that measure, 80% of the increase in long rates since September has potentially been driven by worries about fiscal policy, at least issues that are not explained by changing Fed expectations.
So which of the 3 questions, which of the 3 points that you're making do you lean on as a reason behind the rise in yields?
Well, the challenge is when you do these decompositions and trying to quantify what are the sources of why long rates are going up, is that you don't know this unexplained factor in the term premium, what's driving that. Is that because of fiscal worries? Is it because of, some people say it's just some technical issues with the yield curve steepening? In my view, I think at least it tells you that there's something else going on, because if you look at the chart, it is just really unusual that long rates are going up when the Fed is cutting. So that's why, if it is because the market is worried about fiscal issues, then of course we need to think about, well, what are the consequences as we get some fiscal news potentially over the next several weeks.
A number of people have said this is a good thing and people should embrace it. You see an actual normalization of the yield curve, and that's fantastic. You have a newly positive yield curve, 210s now, the steepest going back to 2022. Do you think that it is a positive development or a negative development?
Well, I think what's lying underneath this is that the expectation was that, when the Fed starts cutting, they always cut a lot. And of course, over the last several quarters, the expectation was that the Fed will cut a lot more relative to what's priced in at the moment. So now, of course, markets are pricing that rates will stay higher for longer, and therefore we will not get all these cuts. So the question therefore is, well, is that good or bad news? Well, it's good in the sense that the backdrop is that the economy is still strong. But the bad news, of course, is that rates higher for longer will continue to weigh, in particular, on balance sheets that are weaker. Companies with a lot of leverage, companies with low coverage ratios will continue to get hit by rates higher for longer. So higher for longer has a number of consequences that are bringing back memories of what we saw in 2022 when you had rates going up and stocks going down at the same time.
With yields higher over the past since the Fed has been cutting, and you're saying some of this is driven by fiscal, we haven't gotten the fiscal package yet, but the incoming Trump administration has made it clear in the first 100 days they want to see something, whether or not it's 1 reconciliation bill or 2. So basically, is that just saying to the Fed, you're on pause until we see exactly what comes out of this proposal?
Well, and I think also to your important point here that it used to be that these bills would be 2 separate bills, one with border and security in the first bill that would be dealt with first, and then later we'll deal with what's going on the tax front. But combining all this, of course, raises the risk that I'll get a Bloomberg headline saying some pretty significant number in terms of what the deficit impact is. So if you do have a bigger risk of a higher headline number, that also raises at least modestly the probability that we'll get some at least potential Liz Truss moment where we could see a fairly significant number coming out, where instead of doing it drip-wise throughout the year, having a big number where suddenly markets say, wow, there's already QT going on, there's a stock of T-bills that need to be rolled over, and on top of that, we already have a 6-7% budget deficit. All that combined means that Treasury issuance continues to be a very important topic.
What does that Liz Truss moment look like in the United States?
Well, the risk, of course, is that if there is a still very significant budget deficit, and if we still have significant issues with, again, the number of T-bills outstanding, meaning short-dated debt that needs to be rolled over, we still have QT. There's a lot of conversations about when that potentially will end. And on top of that, if we do have new fiscal deficit spending and a number that's much bigger than what the market is expecting, that certainly raises the probability, at least, that we might have some situation where the markets are saying, wow, that's a lot of treasury issuance. We already have discussions literally every day when we have a treasury auction around, hey, what was the metrics on the auctions and what are these numbers telling us in terms of the overall fiscal sustainability, which Jay Powell, of course, always keeps on pointing out is already unsustainable.
Lisa mentioned it already this morning. We get a 10-year a little bit later. You wrote about it to close out 24. The risk of a 2022 repeat in the market. How great is that risk?
I think that is much higher than what the market is the probability the market is assigning at the moment. Because remember, the key issue in 2022 was that the 60-40 portfolio really underperformed because rates went up, because inflation was going up, and at the same time stocks went down. And now we've had the Nike swoosh has been flattened out on Fed expectations. So therefore, if we now are getting back to Fed expectations being roughly flat, we have a few cuts priced in. Imagine if suddenly those expectations start to move up, that people are saying, well, maybe we'll get another hike. I do think a lot of equity investors will be looking at that and saying, well, in that case, you already had the trailing PE on Tesla at almost 200. That's why some of these stocks on a trailing PE basis are incredibly expensive. And if you now have that, well, maybe the Fed has to do something more, meaning hike rates again, well, then I do think some of these more sensitive names, they will certainly see a bigger hit. So that's why, given all the stocks returns have been driven by a handful of stocks, I do think that that makes it much more sensitive to if, again, the Nike swoosh sweeps up and we do get a situation where the Fed is pricing in more hikes coming.
Torsten, a clinic, as always. It's good to see you, sir.
Thank you.
Thank you. Torsten Slok there of Apollo. In a second hour of Bloomberg Savannah, just around the corner, we'll catch up with Keith Lerner of Truist, Republican Congressman French Hill, Jason Thomas of Carlisle, and former Chicago Fed President Charles Evans from New York. This is Bloomberg.
In case you missed it on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot, by the
on
way.
beer and groceries and gas and video games.
And
I wish I had
hugs.
kept it. I wish I would buy a Harley today if I had.
Yeah, but you
that
probably wouldn't
Bitcoin.
be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and a beer in my hand.
Don't miss the next Open Interest.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
We ended the year on a bumpy note. We sort of started the year on a bumpy note because we know that we need more clarity. We need more answers.
One of my core beliefs about politics and markets, whatever it is, you have to go through some temporary repricings.
We are at levels that are problematic for the stock market.
We'd expect another strong year, just not to the same extent of 2023 or 2024.
I think we're seeing probably more opportunities in the equity market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Bouncing back from the longest losing run since April. Two-day winning streak on the S&P 500. The second hour of Bloomberg Surveillance starts right now with equity futures up by about 0.1% on the S&P, just about unchanged on the Nasdaq 100. Loads of economic data this week, including payrolls on Friday. Later on this morning, JOLTS job openings, the ADP and claims report you will get tomorrow. Bear in mind, jobless claims usually comes on Thursday, but we've got the late President Jimmy Carter's funeral on Thursday, so claims are brought forward. And also keep one eye, maybe two eyes, on the debt auctions coming a little bit later. Lisa, very focused on this. 10-year notes later on and 30-year bonds tomorrow.
Yeah, $39 billion of 10-year notes today at 1 p.m., $22 billion tomorrow of 30-year notes. And yesterday's 3-year auction didn't go phenomenally. And we should note that usually shorter dated paper does better. If you are having your eyes glaze over as you listen to this and you're saying, really, this again? This is incredibly important at a time where yields on the long end have backed up dramatically, and you see them much higher than the ones in the short end, the highest levels that we've seen going back to 2022, which really has a huge impact on all financial instruments.
Garfield Reynolds, a market strategist at Bloomberg, was talking about how bond investors may face a lose-lose dynamic coming out of Washington. Well, actually, this week, I'm also looking forward to this reporting that President-elect Trump will be sitting down with Republican senators. They won't. We just talked about this with Torsten Slok about how they may see maybe one huge reconciliation package. The bond market might find that very uneasy, and it might unnerve them. Maybe they would need to do two, and potentially these senators can assuage him.
And not just the U.S. bond market, but the global bond market. What happens here is going to put the fiscal squeeze on everybody else abroad. I think the headline that we got out of the UK this morning is pretty clear on that fact, that we've got a UK 30-year yield at a high we haven't seen since the late 1990s, and that's certainly not about growth, and that was your point in the last hour. That's about something else.
It's about debt auctions in the UK, it's about U.S. rates, and it's about the fact that inflation has remained stickier across Europe, across the U.S. It raises a question, are we in a secular inflationary environment that is going to make it very difficult to see rates come down to levels that a lot of these countries need in order to get the growth that they want? And that is the reason why people are trying to answer the question that Torsten Slok was just asking. Why? Why the incredible rise, and how sticky is this?
They've lost fiscal space in the UK. They've lost fiscal space in France. And if the United States comes out with increased debt and deficit spending, they're going to put the squeeze on these countries even more. So what does it mean for markets? Well, Torsten Slok of Apollo is making the case that maybe a big risk for this year is a repeat of 2022. Bad for bonds, bad for stocks. Bad for both.
Well, this is the reason why people are sort of wondering, what regime are we in? And we go back to what Stuart Kaiser was talking about, 2017 or 2018. If you have a situation where the prospect of another Fed rate hike could come back on the table, how much could that torpedo already elevated equity valuations at a time where people still have not wrapped around their heads what the idea of higher for longer actually means for risk assets?
The problem with that is that President-elect Trump is not going to accept a market that's bad for bonds and a market that's bad for stocks, which may mean that might be the ultimate check on what he does in power.
3 minutes of market coverage for the bears. That's enough of that. Equity futures right now in the S&P 500. That was so negative to start this hour. Equity futures on the S&P just about positive. On the Nasdaq 100, we're doing okay, just about unchanged.
Can I just add some positivity?
Please do.
Okay, maybe yields are higher because growth is actually going to do really well. And we're going to get the efficiency from the godfather of AI, Jensen Huang, and his rock star jacket, and he's going to come out and transform the way that we live.
It's a nice bullish story to help you sleep at night. Coming up this hour, Keith Lerner of Truist, as stocks look for a third straight day of gains. I would not let you narrate my stories to sleep at night. Congressman French Hill on President-elect Donald Trump's agenda, and former Chicago Fed President Charles Evans on the Fed's timeline for a return to 2%. We begin this hour with stocks higher, the S&P 500 and the Nasdaq seeing back-to-back gains as investors begin to pile back into big tech. Keith Lerner of Truist cautiously optimistic, writing, the primary market trends remain higher, driven by a resilient economy, supporting solid earnings growth near 10% in 25, yet investors should anticipate a bumpier path relative to last year. Keith joins us now for more. Keith, welcome to the program, sir. Why a bumpier path this year compared to 24?
Yeah, well, great to be with you. Our outlook theme is a bull in a China shop. So kind of as you mentioned, the primary trend is up, but it's going to be delicate. There's going to be some things that are likely broken. I think what we look at, the November pop in the market, then followed by the December pullback, is kind of a microcosm of what to expect. I think one thing, just as a starting point, as far as why it might be a pumpier ride, is expectations, right? Expectations are much higher this year, and markets are all about how things come in relative to expectations. You have to remember, coming into last year, the consensus was looking for GDP growth for the U.S. economy around 1%. It looks like that's going to be around 2.5% for 2024. As we move into this year, we already have those expectations that are somewhat higher. And then, of course, the battle that we all know between the potential good and the potential bad of Trump's policies.
And Keith, why you should have maybe a little allocation to gold in the portfolio. Keith, why does that make sense this time around?
Well, it's just something that's as somewhat of a portfolio diversifier as a whole, and also kind of the geopolitical uncertainty that we're seeing. Central banks are continuing to buy gold. In fact, we just saw a headline this morning from Bloomberg about China continuing to start buying gold again. So we just think that's a good hedge relative to just a stock and bond portfolio.
Keith, the fact that you even want to hedge to the stock and bond portfolio is interesting, especially in light of our conversation just moments ago with Torsten Slok of Apollo. The idea that maybe we could see a repeat of 2022 when both bonds and stocks did poorly, simply because you might have some sort of reemergence of inflation that could prompt the Fed to hike rates. Is that on your bingo card at all for 2025?
Well, it's certainly a risk. We don't think it's the most likely scenario, but I think this, if you look back over the last 18 months or so, when we've seen rates move above 4% and move at a quick velocity, that's been the struggle for the market. It's not just getting above 4 or 4.5%, it's the pace at which we've moved. And if you look at the bond market, which you all have been talking about this morning, really to us, the main reason for the recent move up is you're seeing that term premium, that uncertainty factor really start to rise at a more rapid pace. So I do think that is the risk, but I would also say it probably has to reset on how people think about investing. Now, part of the reason back to tech is because of this, because if you think about small caps as an example, where a lot of people got more positive after the election, they're basically back to where they were pre-election because those interest rates are somewhat higher. So if rates are going to be somewhat higher for longer, which we think is the case, it's going to be hard for something like small caps, which have a lot of floating rate debt, to outperform. And we've been bullish tech all last year in communications, and we're still bullish now. Just an interesting tidbit, not a recommendation, but NVIDIA peaked in June of last year. It was actually flat, or actually slightly negative from mid-June to the end of last year. Semiconductors are still about 7 or 8% below the lows from July. So even though we've had this kind of ramp up recently, we still think there's further to go in tech.
I'm glad that you mentioned this, because so far to start 2025, we've seen this effort to have stocks climb out of a hole that was at the end of the year, but it really has been only big tech. That's been the outperformance. You've seen an underperformance of equal weight, underperformance of small caps. To your point, is that basically the roadmap for the year ahead, with people betting on 1 billion humanoid robots from Jensen Huang?
I would stick with tech as the primary or the dominant theme of this bull market. When we look back at bull markets, every bull market tends to have a theme. This one, as we know, is AI. And when you look back at the late 90s bull market, like tech led until the end as far as relative performance. As you move to the 2000s, it was more about global industrialization. We saw things like EM and industrials lead to the end. So if you believe the bull market is intact, which we do, then it's more likely that AI will and technology will continue to lead. And when that stops, it probably means that we're at the end of this bull market. Again, we're giving it the benefit of the doubt. I will say underneath the surface, you're looking at, only about 25% of stocks in the S&P above the 50-day moving average. So that does kind of go to your point about it. It's really been more tech. I would say we like tech. We like large caps the most. After large caps, it would be mid caps and then small caps, the least within the U.S. But I also think this backdrop still continues to support our longstanding bias for the U.S., which has a lot more tech in the large cap index.
I know your bias is to the U.S., but you also talk about how international market underperformance is at an extreme. And when it's at an extreme, like we saw with positioning yesterday and all those tariff headlines, you can take advantage of it. Are there any areas that you think we should be looking out for that potentially the market could take advantage of?
Yeah, well, since we've been on the U.S. side for several years, I know that becomes a really big consensus heading into this year. So you always start to think, okay, where could the consensus get tripped up a bit? And it is extreme. We just had the worst performance of developed international relative to the U.S. since 1997. And then when we look back at 2016 as a little bit of a roadmap, we saw international underperform initially, and then in 2017, for a couple of months, they outperformed. So I think the risk is you could see a kind of a cyclical rebound, or maybe a short-term rebound, but I still think the fundamentals favor the U.S. So unless you're very nimble, I still think you want to stick with the primary outperformance of the U.S., which we expect to continue, especially if you expect tech to outperform, then inherently you're still saying the U.S. and large caps should outperform because of the weighting within the indices themselves.
Hey, Keith, got some breaking news on a large cap right now we need to talk about. Good to catch up. Keith Lerner of Truist. That name is Meta. Of course, you saw the change in the past week. Nick Clegg is out. Coming in, taking over Joel Kaplan, the Meta Chief Global Affairs Officer, out with this statement this morning. And here's some of the headlines for you. Starting in the United States, we are ending our third-party fact-checking program and moving to a community notes model. We will allow more speech by lifting restrictions on some topics that are part of mainstream discourse and focusing our enforcement on illegal and high-severity violations. We will take a more personalized approach to political content so that people who want to see more of it in their feeds can.
This is a huge reversal from some of the moderation that they had in prior election cycles and, frankly, prior years. This, according to Mark Zuckerberg, some people believe giving more people a voice is driving division rather than bringing us together. More people across the spectrum believe that achieving the political outcomes they think matters is more important than every person having a voice. I think that's dangerous. This idea of the Dojification of Meta at a time when potentially, whether they're catering to this new administration or adopting what basically has been the shifting sands, it remains a debate.
It feels like Joel Kaplan and Dana White are officially in the driver's seat now when it comes to Meta. We want to fix that and return to the fundamental commitment to free expression. Sounds like something you would hear from Elon Musk when it comes to X.
Big changes at Meta and more big changes still to come, I'm sure, for corporate America. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. The Wall Street Journal reporting this morning that the Biden administration is in negotiations with the Taliban to swap Americans detained in Afghanistan for at least one prisoner, an alleged Osama bin Laden associate in Guantanamo Bay. The Taliban is seeking an additional 2 prisoners in exchange for the Americans. President Biden has reportedly not made a decision on the proposal yet. Hedge fund Bridgewater Associates has laid off about 7% of its workforce, affecting about 90 employees. A spokesperson for the firm said that the layoffs are meant to keep the organization nimble and flexible. The cuts now bring the firm's headcount back to where it was in 2013. Similarly, hedge funds Two Sigma and Brevin Howard also cut about 10% of their staff last year. A patient in Louisiana who tested positive for bird flu has died in the first confirmed death linked to the respiratory virus in the U.S. The patient was over the age of 66 and had underlying medical conditions. Louisiana's Department of Health said that there were no additional cases found and no evidence of human-to-human transmission. The CDC says that there are currently 66 confirmed cases of bird flu in the country. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Trump returning to Washington.
If I'm Donald Trump, if I'm chief of staff to Donald Trump, Why do I care if it's one bill or two? How do I get what I want? How do I get my agenda approved?
We'll talk about that next on the program with Congressman French Hill.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
If you are just tuning in, welcome to the program. Stocks are positive on the S&P 500. A kick-off Tuesday morning, up by close to 0.1%. Under surveillance this morning, Trump returning to Washington.
If I'm Donald Trump, if I'm chief of staff to Donald Trump, why do I care if it's one bill or two? How do I get what I want? How do I get my agenda approved? If you tell me I get a better chance of doing that with one bill, yay, let's do one bill. If it's got to be 16 different bills, I'll do that. Historically in Washington, D.C., the reason you get these massive bills that everybody says they hate is that that's what passes.
So here's the latest this morning. Donald Trump heading to Capitol Hill tomorrow as the president-elect pushes Republicans to pass a single massive bill containing his priorities. Trump looking to secure a House vote on immigration, energy, and extension of the 2017 Trump tax cuts by April. The Republican Congressman French Hill of Arkansas joins us now for more. Congressman Hill, good to catch up with you as always, sir. We'd love your opinion on what you think is the best way to pursue the president's agenda. Is it through going after just one big bill?
Well, Jonathan, it's great to be with you. Yes, I do support one bill because I think that's the easiest way to get the votes for the president's priorities in the House, which include, as you said, energy permitting reform, securing the border, and of course, debating and completing an extension of the Trump tax cuts from 2017.
Congressman, we've been debating around this table how much the 10-year yield has a seat at the table when deciding what kind of bill and how big it is when the Congress meets and possibly passes this as soon as April. What's your view on this? How much of a veto power does the bond market have?
Well, Lisa, look, I don't think it makes any difference on that point, whether it's one bill or three bills, to the point of your previous commentator. What I think's concerning to me is that I wish we'd finished FY25 spending last Congress. I think that would have been in the president's best interest. But instead, this first quarter, we're going to do both. We're going to complete fiscal 25 spending by the middle of March, and we're going to try to do budget reconciliation with the House and Senate before early April. That's a big lift, and it may demonstrate a little uncertainty on the part of the bond market, but I think the real issue is let's get spending under control through budget reconciliation. That's the purpose of budget reconciliation.
It's a procedure by which you can do big things in Congress using 51% vote margins in the House and Senate. President Obama used it to create Obamacare. President Trump in his first term used that to reform the tax code. So Republicans in the House and Senate this year want to use budget reconciliation to get federal spending under control while we also extend the pro-growth features of the Trump tax cuts.
Congressman, one of the concerns that we hear from a lot of fixed income strategists who come on the show is that they're not seeing where the cuts are going to come into place in this reconciliation bill. Where are they going to come?
Well, we had a meeting all weekend where we worked with our committees of jurisdiction on determining cuts in spending across the board, with the exceptions of what President Trump has taken off the board, which would be Medicare and Social Security benefit areas. The rest of it's on track. And you know how much spending has gone up, and just since the pandemic, we're running a $2 trillion deficit per year, 7% of GDP. That's the part that's unsustainable. Everyone in Congress knows that. So we've got to get our spending on a more sustainable, predictable front. I think that would benefit the bond market if they saw that kind of work on the part of Congress.
Well, we have the CBO talking about at least 1 point of that one big, beautiful reconciliation potential bill, which would be just extending TCJA over the upcoming decade would cost $4 trillion. On top of that, the president-elect continues to talk about no tax on tips. How much do you think can actually get through this Congress?
Well, look, Anne-Marie, you had CBO also say that the Tax Cuts and Jobs Act, when they did not dynamically score it, would not produce increased revenues over a 10-year budget window. And in fact, since 2017, you've seen record federal revenue pour into the country from no more reversions, people bringing taxable income back, the investments that were made, GDP growth, job growth, wage growth was all up in those years following the Tax Cuts and Jobs Act, but before the impact of the pandemic. So I don't believe House Republicans are governed completely by the opinions of CBO exclusively, even though that's an incredibly important component, because we've seen how in error estimates are from the Joint Tax Committee and from CBO, not recently, but for the past 50 years.
Congressman, you're also now the chair of a very powerful committee, the House Financial Services Committee, and we see a number of representatives going to Mar-a-Lago this upcoming weekend. Will you be there, and if so, what do you plan to discuss with President-elect Trump?
Well, President Trump has invited the committee chairs to a dinner, and we'll be talking about our priorities that we have for the first few months of his administration and getting his views on those.
What are your priorities? Specifically for the Financial Services Committee?
Well, you know, we've talked about that many times. I've got 3 big priorities. First, I want to right-size the regulatory system for particularly community banks. I think that's an important feature that's gotten off track, particularly in the Biden-Harris administration. We want to make sure the SEC is focused on capital formation and investor protection and orderly markets, and not a political agenda that soon-to-be former Chairman Gary Gensler had. And finally, we want to have a market structure for innovation in this country where people can use blockchain, can use digital currencies and digital assets to advance their business mission and make sure that the U.S. is a leader around the world in this new Web3 innovative technology.
Congressman, we also need to talk about the Fed. Yesterday, Michael Barr stepping down, you welcomed that. This morning, the Wall Street Journal in an editorial is talking about that maybe a replacement for Michael Barr will be Governor Bowman. Would you welcome that?
Mickey Bowman's done an outstanding job as a governor on the Federal Reserve. She comes to the Federal Reserve with practical experience, both as a bank commissioner in Kansas, as well as a family connected to community banking business there in the heartland. She's been a great voice for common sense and tailoring and regulation, and I think she would be, if President Trump made that decision, that would be, in my view, a good one.
Congressman, we're seeing some big shifts in corporate America as well. We'd love your thoughts just to close up this conversation on what we just heard from Meta moments ago. And if you missed it, because it only broke about 15 minutes ago, I'll give you a summary of it. This came from Meta about 15 minutes ago. That starting in the United States, they're going to be ending their third-party fact-checking program and move to a community notes model, something we're more familiar with the likes of X. We're seeing some big shifts around corporate America. I think taking note of more conservative voices in the last few months, particularly after the election in early November. That is notable, I think, Congressman Hill, for corporate America, and I just wonder how you're responding to things and what you think of that shift.
Well, Jonathan, over the decade that I've been in Congress, for basically 3 decades before that, I was in corporate America, both with public companies and private companies, and I've never been a big fan for bringing politics, partisanship, and social policy fads into the corporate boardroom. I think business should be in the business of delivering a product that meets the needs of consumers, all consumers, no matter what their walk in life is. And so that's why I think it's good that business appears to be getting back focused on conducting their mission and leave the politics at home or out with their friends.
French Hill, appreciate your time, sir. Congressman French Hill
good to be
of
with
Arkansas.
You,
good to see you, sir, as always, down in Washington, D.C. Just finishing up there on some of the changes we're seeing in corporate America.
A question about what kind of role they're taking, how much this is shifting to conservative versus just simply exiting the stage left. I want to make a note, though, just to build on what you were talking about with that announcement from Meta, from Mark Zuckerberg. They talked specifically about their efforts in 2016 to have third-party moderators. And why it failed was because those independent moderators were no longer independent and actually had their own views and biases. It was almost a walking back of what happened following the 2016 election.
And it's really not a surprise given post the election and all these executives that have been going down to Mar-a-Lago speaking to President-elect Trump. I was putting together a list of the shift we've seen in all these companies.
Sure.
McDonald's yesterday, Meta yesterday and today, Walmart, Tractor Supply, John Deere, other companies as well, Ford, Caterpillar, Boeing, and the list, I think, will continue.
Everyone wants politics out of corporate America. Everyone I talk to, anyway, and maybe that's just my crowd. I'll say this, though. Are we really taking politics out of corporate America?